there is not an all clear from a tariff policy perspective.
We know the administration is going to push back. They're going to push back hard.
The tariff levels that we had yesterday are probably going to be the tariff levels that we have tomorrow.
It would be a little bit foolish for countries to just assume that this is over.
The worst case is definitely off the table, no matter what happens in the court case.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back. It is Friday at the end of a very long month. We are poised for the biggest monthly game since November and an increasing focus on economic data as traders grow increasingly numb to policy roulette. Yesterday, a perfect example of this, with traders getting really excited about the courts possibly rejecting some of President Trump's tariffs. And then, Annmarie, getting a reality check.
A reality check where basically nothing's changed. The courts basically said in this appeal that the policy can stay at the moment while it works its way through the courts. In the meantime, front page of the Wall Street Journal this morning is also talking about the fact that even if this was to be struck down in the courts using a VIPA, the administration has multitude of options they can go through, and they're working through that. And that's basically what Peter Navarro told us yesterday on this program. Nothing's changed. We have other avenues. Meanwhile, the Treasury Secretary last night sounded confident that some trade deals would come to fruition. He said this morning in his office will be a big Japanese delegation. The question is on China, though. He says talks there have stalled.
All we can say is heads are spinning, and a lot of people are starting to ignore the daily grind and fire hose of data and information that we get on the policy front. However, the economic front is getting more and more relevant. Today, we have personal consumption, personal income, and core PCE, which is the key inflation metric that may shed some light on the underlying inflation picture at a time when suddenly that is the most relevant aspect for a lot of traders.
Absolutely. Everyone wants to see whether or not the hard data is going to weaken to where we have seen a lot of the soft data and a lot of these surveys. What's so interesting also is the timing of all this. This is coming at a time when the Fed said they are fully data dependent. They're going to be looking at the economic data, and they said that to the president's face just yesterday when Jay Powell went into the White House for his first meeting with Donald Trump since inauguration.
So let's talk about that. Do we have any color about what actually ignited this meeting with Jay Powell going there and President Trump telling him, hey, you need to cut rates, and Powell saying, not really?
I'm not sure exactly what ignited it. I think the fact of the matter is it is normal for the president to sit down with his Fed chair. Although the Fed came out and made it very clear they didn't discuss monetary policy, but this is what the press secretary had to say. The president did say that he believes the Fed chair is making a mistake by not lowering interest rates, which is putting us at an economic disadvantage to China and other countries. So this is what they're saying very publicly, but we already know where the president stands when it comes to monetary policy.
Meanwhile, very much all eyes focused to the drumbeat ahead of jobs that we get next Friday, which could really determine how much of a boom or a bust we get in the key bond market, which has been the real arbiter for so many different metrics. We are seeing the likely jobless claims. Yesterday, we did get initial jobless claims and continuing claims pick up to levels that were somewhat concerning. And there is this issue of how much the consumer confidence data matters. Today we get University of Michigan sentiment data at a time. How much is this White House aware of polling and the idea that sentiment has actually bounced back quite considerably in the past couple of weeks?
I think one thing was really key when we saw the confidence report, the survey recently, and that was the fact that in there you had consumers say gas prices are lower. That is something this administration really wants to see, and it's actually pivotal to their entire economic agenda.
Right now, we are seeing stocks coming off just a little bit, but it has been the biggest monthly gains if it continues so far this year, going back to November. Right now, just a little bit softer on all of the indexes. Yesterday, we eked out a gain after the roller coaster of what we got in terms of trade news. In bond markets, you are seeing yields pretty much somnolent. Coming up, John Stoltzfus of Oppenheimer as the rally fades on tariff uncertainty. Neil Dutta of Renmac with President Trump putting Fed Chair Jay Powell in the hot seat again. And Steve Englander of Standard Chartered on why a U.S. dollar crunch might be looming. We begin this hour with stocks steady, the rally fading as tariff jitters once again consume markets. John Stoltzfus of Oppenheimer staying bullish, writing, we remain positive on equities. Pullbacks earlier this year have mostly looked like trims and haircuts for the S&P 500. John joins us now. John, wonderful to see you. Happy Friday. It feels like a very long week, a very long month. Does the rally that we have seen in the month of May make you more or less excited about getting in?
Oh, it makes me more excited of staying in and then looking for any babies that get thrown out with the bathwater as we go through inevitable some volatility going forward as things get worked out in Washington and among other countries around the world. and between parties.
What have we learned over the past month? And I don't mean this from some sort of existential level, but in terms of how companies are dealing with the tariff uncertainty and the tariff reality that's already been imposed.
I think what we've learned is that it is most certainly idiosyncratic. So it depends upon the management of a company, what type of business they're in, where they are sourcing their goods, or where what the effects of tariff policy are on them. When you look at just earnings season. I mean, earnings season for the S&P 500, it's over 12% earnings growth year over year. You've got three sectors, or if not four sectors, double-digit earnings growth. Among them includes both technology and communication services, two sectors that were practically written off for dead at different points this year by some analysts. So we think, if anything, this is the reality of an environment in which we're seeing a very different change offered by this current administration in Washington related to trade. And it's a policy that was in place for, well, it goes all the way back to the end of World War II when the U.S. rebuilt the world. But it's 80, 70, 60, 50, 40, 30, 20, 10, right up to now years. Essentially, we've given away so much of our manufacturing processes. We are the consumer of the world, okay? So while the rest of the world has built overcapacity in manufacturing. So
yeah, well, let's put the concept aside of what the ultimate goal is and go to the actual implementation of it, given the fact that we've had a lot of back and forth about what the policies are, and a lot of companies have said, look, we're okay with tariffs. We can manage through it. Just tell us what they are and give us some policy certainty. Do we have any more policy certainty today than we did on April 30th?
I would think not a heck of a lot more, except we do know one thing that we have seen since as this year has progressed has been a willingness by the administration to extend deadlines related to tariffs that appear onerous. The April 2nd rates of tariffs were stunning. I mean, we weren't looking for that. And I think the market reacted. The administration responded. So I think but I do think it is, ultimately is, I rely on music a lot for things. I think it's what the Temptations used to sing, which is the way you do the things you do. And I think there's a real issue here in terms of how things are communicated sometimes by the administration and by their detractors also, which actually extends the process of arriving at some kind of resolution, I believe. But who's asking me, other than you're so kind to ask me? I don't think either the administration or the opposition to the administration is asking me for an opinion.
Well, what have you learned in this whole process? Not to be too cute, but that idea of the taco trade. Trump always chickens out. Is there truth to that? Because we have seen him take these reprieves when the market has pushed back.
Well, I think I don't know if it's so much that he chickens out, but he certainly does change his regime in terms of the policy of the day, and that probably has to do with the Art of the Deal, which is a book that I think I'm going to order from the big box delivery people today. I think I haven't read it in all these years, but I think I better. But when I look at it, I think this is a process. It's impacted by the fact that every day is one day closer to the midterm elections. And in that process, I think that that's why so many things have been implemented so quickly, and perhaps in a way that has not been has been well received, that might be better received if discussed and negotiated.
You mentioned the Art of the Deal. There's lots of different trade negotiations going on right now, but the most important one, arguably for the market, is with China. And the Treasury Secretary says those talks have stalled. How concerning is that for the direction of travel for equities?
I think it certainly is if it were to go on for an intermediate to long period of time. But in a short period during negotiations, we would expect in tough negotiations, both sides with definite opinions that are in conflict with each other. I think it's quite normal. It's never easy, this kind of thing. And I think it's unrealistic for us to expect so. Traders will play it either way on a day-to-day, minute-to-minute basis. But for intermediate term to a longer-term investors, we'll come out of this in some format that'll likely be good for the markets.
It's why I find so shocking sometimes that people think we're past peak uncertainty when it comes to trade policy. If you look at Trump's first administration, phase one trade deal took years, and they were just dealing with China. aren't we going to see stop and go reactions from Beijing and Washington the next 6-12 months?
You know, you never know. The big problem for China is they have phenomenal overcapacity in manufacturing in a domestic economy that still is not big enough 40 years into the China story to absorb the lack of a large client. You know, the U.S. as a client, whether it's U.S. consumers or U.S. businesses, we buy in size. And that's a great thing for countries that have overcapacity in manufacturing. Look at the gains that Mexico has had recently. And full disclosure, I'm half Mexican, okay? So I really understand. The maquiladoras lost an incredible amount of business to China over the years, and they've gained a lot of that back. But we'd have to say this is going to be, we think we come out of this not at the end of globalization, but re-globalization, further diversification of globalization, beneficial to both developed international markets as well as emerging markets, even frontier markets, because there are just some things that aren't coming back to the U.S. You know, it's those businesses that are important for national defense, national health care, not to confuse that with the British National Health Care Services, but just in terms of where we source our medicines, whether it's over-the-counter or ethical or prescription medication.
There's a sense that the new order, whatever it may be, will cause less fundamental demand for U.S. assets, in particular the dollar, in particular bonds, and you have seen those jitters really come to the fore over the past couple of months. Why do you reject that and still like bonds?
You know, I tell you, I'm not a buyer of the end of U.S. exceptionalism. I don't think it's an end of that. If anything, it's just it's an interim period doing this where there's a lot of questioning in the near term what goes on. I'm an equity guy, as you know, so I like fixed income for current income, diversification in a portfolio. But I think when you look at it, what are the alternatives to buying U.S. debt, even with the most recent third downgrade over the course of the last 10 years or so? What you have is you still have the accountability, governance, and transparency. Just look at the arguments that are happening in Washington. The rule of law, as it applies to both one side and then coming back and appealing the law and back and forth. We've had this since this country began. Although as old as I am, I wasn't around for you know, Adams and Thomas Jefferson's arguments. But I think it's important. Context is key. You know, Bloomberg says that in their commercials. We said that for years in our pieces. Context. It's one of the pitches. What I offer is context. I've been around in this business since 1983. Every boom, bust, and recovery cycle. I've seen the world going to end 1 million times. It would seem, not really 1 million times, but this is a great system. And the other thing is the interaction and interdependencies of trade really require countries to come to some kind of an agreement for the simple needs of their populations and their economies. So, but it's the way you do the things you do.
All right, when the temptations ending the segment. John Stoltzfus of Oppenheimer, thank you so much. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Danny.
Good morning, Lisa. President Trump's tariffs will remain in place for now. An appeals court temporarily paused a ruling that had blocked them. The possibility still remains, though, that the appeals court could ultimately back the original ruling. White House officials say Trump has options to pursue similar tariffs, though, through other authorities if appeals fall short. Elsewhere, Treasury Secretary Scott Bessent says trade talks with China are currently at a bit of a standstill. Bessent says a call may be required between President Trump and President Xi Jinping in order to reach a deal. Trump said he would speak to the Chinese leader in the days after trade talks earlier this month, but a call has yet to take place. President Trump met with Fed Chair Jay Powell at the White House, their first in-person meeting since the inauguration. The Fed says the president invited Powell to discuss economic developments for growth, employment, and inflation. White House Press Secretary Caroline Leavitt says Trump pushed Powell to lower interest rates and did not discuss whether Trump would seek to remove Powell. And that's your brief. Lisa.
Thank you so much, Danny. Up next, striking the best deals.
The president absolutely has the right to set the trade agenda for the U.S. This administration is committed to fair trade, and we are striking the best deals for the American people.
Alex Nowrasteh of the Cato Institute joining us next. This is Bloomberg Surveillance. We are poised for the best monthly gain going back to November, the first monthly gain of the Trump administration 2.0 after steady losses since January. Today, we're taking it back just a little bit, but still up about 6% on the month. NASDAQ go down by about 0.2%. In the bond space, we actually have stability and strength. After yesterday, we had a pretty solid auction, 3 for 3 in terms of solid bond auctions so far this week, as well as the sense that maybe inflation is cooling. That comes ahead of that core PCE reading that we get in about 2 hours and 13 minutes. Under surveillance this morning, striking the best deals.
The president absolutely has the right to set the trade agenda for the U.S. This administration is committed to fair trade, and we are striking the best deals for the American people, and anything that the courts do to get in the way, both harms the American people in terms of trade and in terms of tariff revenue.
Here's the latest. Treasury Secretary Scott Bessent saying several large trade deals are near after the federal appeals court temporarily upheld the Trump administration's appeal to keep tariffs in place. Bloomberg's Mike Shepard in Washington and Adam Blenford in London joining us now. Shep, I want to start with you. What's the latest state of play after yesterday's court turmoil over just whether some of these trade provisions are legal or not?
Well, the turmoil is far from over, and in fact, it will continue for the next few weeks, this uncertainty, as the appeals court takes briefs from both sides in the case to weigh further whether to uphold the trade court's decision that the tariffs crossed the line, that the president went too far in invoking these emergency powers under a 1977 law to impose the reciprocal tariffs, as well as those connected to fentanyl against China, Canada, and Mexico. So we will have to see. And no matter what this court decides, Lisa, we could see this case go all the way to the Supreme Court, given the stakes. And the administration has made very clear that if it loses at this appellate level, it will go to the highest court, Lisa.
There's a question right now, and Adam, I'd love to bring you in about what this does to the state of trade deals currently ongoing. We did get some color on that yesterday. What's the latest, particularly with U.S. and China?
Good morning. Well, on the U.S. and China, it's very interesting what Treasury Secretary Bessent said late yesterday as well in your hours that talks have somewhat stalled. There was that agreement a little while ago after those talks in Switzerland to pause the punitive tariffs, the very highest levels of tariffs. But Scott Bessent suggesting that would need a call between the principals, President Trump and Xi Jinping of China. That was a few hours ago on your program. John Liu, our Beijing bureau chief in China, suggesting that that's something that the Chinese would be very cautious about and quite reluctant to put Xi Jinping on the phone. I thought it was interesting that we've seen Vladimir Putin and President Trump talk in recent weeks with a view, of course, the president saying that this would help resolve the war in Ukraine, but that, as at this point, hasn't happened. So it'll be really interesting to see how this all plays out as President Trump attempts to kind of use what leverage he has on the international stage to keep those trade talks going. Interestingly, one little side note that the ongoing dispute with the EU over trade, those talks are continuing. EU Trade Representative Maros Sefcovic posted just this morning that he held, and he quotes, forward-looking solutions talks and staying in permanent contact with Commerce Secretary Howard Lutnick. So these things are still rolling on despite the legal limbo at the moment in Washington.
Adam Blenford, Mike Shepard, both of you, thank you so much for absorbing the fire hose of policy data and trade discussions that we get every single day. Joining us now is Alex Nowrasteh of the Cato Institute. Alex, I just want to start there. What have we learned, if anything, over the past couple of weeks and the past couple of days in particular, with respect to the legal process involved with some of these tariffs?
Well, I think we've learned quite a bit. If you recall, Trump's Liberation Day tariffs were initiated under the authority of the International Emergency Economic Powers Act. The U.S. Court of International Trade, however, ruled that that was unlawful, striking down those tariffs. The Court of Appeals now, the Trump administration is appealing this, has said that they are putting the tariffs back in place, at least temporarily, while they hear this. I think what we've learned is that there is an incredible amount of policy uncertainty in the United States, both coming from the courts and from the administration. The Trump administration has imposed numerous tariffs the second time on lots of different countries, under mainly the IEEPA authority that was struck down by the Court of International Trade. But on the other hand, the courts may be finally showing some backbone and some desire to reduce the unlawful congressional delegation of trade authority, which rightly rests with Congress and the Constitution under Article 1, Section 8, trying to claw that back and say, no, I'm sorry, Congress, you can't give this power to the president, even if the president invokes magic words like declaring an emergency.
But Alex, is there really policy uncertainty when the direction of travel is not going to change? Even in the court's own ruling, it talks about how the administration basically tells them you could have just used Section 122 to get your goal.
So the direction is not in doubt, but I think the magnitude and the severity of the trade restrictions are in doubt and are up in the air, and the stability of these. So for instance, if there are other trade authorities that the president has that allow him to raise these tariffs, and there are different sections, there are subject to different constraints in the law. There are different constraints, different types of emergencies, different types of findings that need to be made in order to justify those tariffs. So he is bounded a little bit more by some of those other tariffs than he is by the International Emergency Economic Powers Act, at least as he interpreted it. So there are some other restrictions on there, but I think what this could mean, if it's the best, is this goes to the Supreme Court and they rule that this is a non-delegation or this is an unlawful delegation of power. That would be the best outcome, is to put this in the hands back of Congress. I know, Congress doesn't show itself to be very competent or very assertive, but maybe this is one way to get them to actually do their jobs.
Well, Alex, how do you think this is impacting the current negotiations the administration is having right now?
So that's a great question. I don't have a lot of faith in these current negotiations. We heard about the British trade deal that came out. It was really not that impressive of a deal. Tariffs are still higher in the United Kingdom than they were before Liberation Day and before Trump came to office. So we hear a lot about these deals. We don't know a whole lot of details about what they will be. But what I do know is that Secretary Bessent and others in the administration are using terms like fair trade, which I'm old enough to know and to remember that fair trade was a talking point used by protectionists and anti-trade people 20, 30 years ago. So I'm not hopeful that these deals are going to meaningfully liberalize trade. Maybe more liberal trade than after Liberation Day, but certainly trade policy will be less liberal, will be less open, will be more taxed, and will be more regulated than before Trump took office.
Alex, just quickly here, I'm curious how much you're watching the tax bill as one venue for trade policy, in particular Section 899.
So I'm not familiar with Section 899 specifically of the trade bill. Which section is that?
Well, basically this idea of taxing foreign capital coming into the United States, the idea of the backdoor ability to curtail trade on some capacity.
Yeah, so taxing capital that comes in the United States is just a horrendous idea, and it will reduce American exports. A lot of American exports are financed by the capital account surplus into the United States. So that is a horrendous idea that pushes actually against the president's stated goal of trying to expand exports and reduce the trade deficit. Furthermore, it will reduce the opportunities for American businesses to borrow in the international market.
Alex, thank you so much for your time. And there are so many different esoteric provisions. It's hard to keep track of them for all of us. Alex Nowrasteh of the Cato Institute. And we're all watching to see what other ways they're going to try to affect trade.
Right. And Deutsche Bank's George Severella says basically you can turn a trade war into a capital war by using this provision, which they might use in the One Big Beautiful Bill.
Coming up, we've got Neil Dutta of RenMac with President Trump putting pressure on Fed Chair Jay Powell yet again. This is Bloomberg. We are coming into the last trading day of the week, of the month, at a time where finally we're seeing gains, a 6.2% gain on the S&P 500 so far for the month of May. We are taking a little bit of that back this morning, but just, and there's the sense that actually some of those losses are being clawed back as people look at some of the earnings reports and some of the economic data and get comfort. No drama in the bond space. And you are seeing, for the first time in a while, a little bit of dollar strength. 3 hours away from the cash open, here is your Morning Movers with Danny Berger. Danny.
Hey, Lisa, I got some earnings for us to go through that reported after the bell yesterday. Dell, really solid set of results, up more than 1.5% in the pre-market. It's all about AI servers for them. And because of the strength there, they've upgraded profitability. They've upgraded their earnings, exceeding expectations. They have $12 billion worth of orders in the quarter that they just reported for AI servers. That's more than they brought in the entirety of last year for them. Interestingly, consumer PCs falling 19%. Now, speaking of weaker consumers, we also had some retailer earnings. Gap was a disappointment for this market. You can see it in just the reaction, down 17%. Part of it was what they said about tariffs. They see a $300 million hit coming on because of tariffs, but you also saw some weaker sales, especially in some of their smaller brands. American Eagle, a very similar story, a tariff hit and already weakness. It was a perfect storm for them. They had a lot of discounting. They also had weaker sales really across the board for their brands. And at the same time, inventory write-down so difficult for these retailers, especially when they're already struggling to understand just how much inventory to stock up as things get more expensive. Lisa, those shares down 7.8% in the pre-market.
Thank you so much, Danny. And great points. And Annmarie, it's something that we've been talking about. Some of these clothing companies have tried to reshore to Vietnam and are getting a hit on that front with tariffs as well as sort of out of the fire into the frying pan.
Very challenging, especially when you just, as you mentioned at the top of the show, you don't know the direction of travel because there is no certainty right now. And the last 24 hours basically has showed companies, even if you're planning for something, it might be struck down legally. What I have to say, though, and Jonathan always brings this up with the retailers, are tariffs a convenient excuse if your brand is just not doing so well and people actually just don't want to buy those clothes?
Yeah, if Athleta is maybe losing market share to Vori. Meanwhile, on the policy roulette on our radar this morning, President Trump's levies winning a legal battle. A federal appeals court temporarily halting a ruling blocking the majority of the Liberation Day tariffs. The government now has until June 9th to reply. And right now we're getting the sense they will fight to the end on this one.
Absolutely. And the Wall Street Journal this morning on the front page talks about what they are going to do, this twofold response, which honestly, we talked about all day yesterday on the show. What are the options, the menu the president and his trade advisors have in front of them? And the Wall Street Journal says they're thinking about doing this stopgap bridge using Section 122, which the ruling said this would have been more legally viable to use until they go to a point where they can have a process in place to go to individual tariffs based on sectors or based on country specific. This is what Peter Navarro said. He said, none of this was taking us by surprise. We have a plan B, and nothing's changed this morning. Tariffs are going to stay. The direction of travel is there, but there might be some bumps along the road.
Well, but the bumps are important. And actually, how long it takes is important. Why is time so crucial for them that they wanted to jam this through much more quickly, if in a more legally tenuous way?
I think there's two things. One, the president wanted the entire scope at his proposals. He wanted to go as high as he could to negotiate. This whole idea of art of the deal, go to the highest number you can, and then he himself can drop it. And to do that, you have to use IEEPA. If you use Section 122, you can only go to 15%, and you can only use it for 150 days. So it gives the president a lot more leverage. Also, they want to get the tax bill done. And even though the CBO won't use the revenues from tariffs, they want to make sure that they are showing they have tariff revenue coming in, which is why they want all these deals to be done by July 9th to coincide with what they hope a July 4th deadline for the One Big Beautiful Bill.
Well, talking about those deals, and you asked a great question earlier, which is how much do the court cases affect ongoing trade negotiations? U.S. Treasury Secretary Scott Bessent warning that trade talks with China are stalled, saying a call between President Trump and his Chinese counterpart Xi Jinping may be needed to strike a deal.
And I'm not really surprised about this at the moment, because what have we seen since Geneva? And you and Jonathan spoke to the Treasury Secretary. The markets were on a high. Everyone was excited. This was the rapprochement détente between Beijing and Washington. What have we seen? The United States go after more of their chip sector. They wanted to block Huawei from being bought from their allies around the world. Some jet engines potentially might not be able to start going over to China. We have reporting from Reuters that they're going to send potentially more arms to Taiwan than Trump agreed upon in his first administration. So you do see a ton of tension brewing between Washington and Beijing since those talks happened in Switzerland.
Meanwhile, talking about pressure and tension rising, President Trump again putting pressure on Fed Chair Jay Powell to cut rates. At their first in-person meeting since the inauguration, Powell reiterated the policy will depend on incoming economic data. And we have quite a bit of it coming up at a time when a lot of them say they don't have the justification right now to cut the way the president wants.
Which is why at 8:30, this economic data dropping is going to be so important, because it's what the Fed looks at. I wish someone was a fly on the wall that we can all call up and talk to about this meeting, and maybe some of that will start to leak out. The president has been jawboning Jay Powell since he got in office, saying he's too late, Jay Powell. Wonder if he used that name to him in person. I imagine the Fed chair went in and said what he has been saying publicly. We're going to be data focused. Monetary policy you cannot have any control over. Caroline Leavitt, though, did say the president voiced his concerns. He believed the Fed chair is making a mistake by not lowering interest rates, which is putting us at an economic disadvantage to China and other countries. Trump loves to message about this. China's cutting rates, the ECB is cutting rates, the Fed why aren't you?
Well, there's a real question about whether the economic data actually justifies it. And someone who's been making that argument for quite a long time has been Neil Dutta of Renmac, who does join us now. Neil, what did you make yesterday of the rhetoric coming out of the White House in the first in-person meeting between Jay Powell and President Trump 2.0?
President Trump wants lower rates. I mean, that's not exactly breaking news, in my opinion.
There is a feeling, though, that there has been a number of data points, in particular yesterday's revision to GDP, that shows personal spending, personal income isn't necessarily keeping pace. We're expected to get core PCE today that does show that ongoing disinflationary trajectory. Do you think, even with some of the on-again, off-again tariffs in the sense that companies have adapted and adjusted, there is a legitimate argument for the Fed to be cutting more aggressively?
I do. I think the Fed's job is to make decisions with imperfect information. So just using uncertainty as a crutch to just wait everything out is sort of besides the point. I do think that companies are probably, for the time being, I mean, I think they're eating much of the sort of inflationary impact of the tariffs. They're eating the tariffs. They're the ones that are bearing the cost. Margins are probably being squeezed. So it's not like it's a good thing, but I think the demand shock is more important to be focusing on. And this was going into a situation where the economy was already getting worse. And so, when I look at the data, I mean, to me, the most important thing that happened this week is that extended unemployment claims hit a fresh high. That's important. Job finding rates are low. And, even though initial layoffs are low too, the fact that those newly laid off people can't find any work is basically why the sort of ranks of the unemployed continue to grow. So I wouldn't be surprised to see, the level of permanent job losers tick up a bit more when the next employment report comes out. So you can't rule out ongoing increases in the unemployment rate. The economy is growing below potential, and that's making it very difficult for laid off people to find work. And as a result, the unemployment rate will keep rising.
Well, let's talk about the next jobs number. It's going to be Friday, June 6th. What are you expecting, Neil?
Well, I mean, I wouldn't expect much. I mean, I think I wouldn't rule out like a 0.2 increase in the unemployment rate. Continuing jobless claims are basically sending you a message that the unemployment rate's going up. We may well be at the Fed's unemployment rate forecast for Q4 a couple of quarters ahead of schedule.
Would that be enough for the Fed to cut, do you think, given the fact that they talk about the uncertainty of policy in Washington?
I don't know that it'll be enough for them to cut in June, but it'll probably get the markets betting on cuts, more cuts, and sooner. So maybe it ups the odds of July. But I think, frankly, you can't rule out a scenario where, it kind of looks like, what we saw last year, where they're waiting, and then all of a sudden, they make a very sort of abrupt pivot and do more than expected.
Neil, why doesn't the long end of the yield curve worry you? The fact that some people believe that there is going to be longer-term structural inflation and a term premium, and the Fed looking more accommodative will only expedite that.
Sure. I don't know that that's the reason why the long end is elevated. A lot of it, I think, has to do with what's going on globally. I mean, even if you look at some of the movements, in rates this year, it's been happening on days of some sort of some global development, whether it's a bad Japanese bond auction, bad inflation data overseas. What we know is not that people don't want to hold U.S. long bonds. They don't want to hold long bonds. I mean, the curve is steepening everywhere. So I wouldn't lay that, as purely like a U.S.-centric thing. I think the bigger story is that, the markets haven't really had to come to grips with the idea that the economy might be slowing. We haven't really had that one piece of very, bad hard data where it's like, oh, aha, like sort of, recession risks are higher than we thought. Yeah, and when that happens, I think you'd probably see, Mother Nature kind of taking course, not only for equities, but with the fixed income market as well.
Mother Nature is a fickle creature, as you know, and there's been a change in the narrative recently with the U.S. Economic Surprise Index actually rising to some of the highest levels that we've seen in months. You've seen consumer sentiment actually change to up itself closer to some of the hard data. What gives you confidence that especially as some of these tariffs get rolled back from worst case scenarios, there will be a slowdown that is not showing up in a lot of the earnings that we're getting at a number of different companies that are managing to weather this just fine?
If you punch someone in the face over and over and over again, and then you decided not to punch them in the face, would that mean that they would be okay at that point? That's all the confidence data is telling you, right? I mean, I don't know that there's anything interesting in that. To me, the most interesting data point within the confidence survey was simply that consumer attitudes around the labor market kept getting worse. To me, all the confidence data are reflecting is the fact that equity prices rose. Nothing else. And, it's important for people to remember, even though the stock market's had a really good run over the last 12, 18, 24 months, that hasn't stopped labor market conditions from continuing to cool off. That hasn't helped. I mean, you talk about loose financial conditions. How about that? If financial conditions are so loose, why are home sales so weak?
Because mortgages are still so high,
I would
Neil.
take issue with the idea. Sorry, go ahead.
Well, mortgages are still too high for a lot of people to get on the property ladder.
Exactly. So that means that financial conditions are, in fact, not that easy.
Neil, this goes to the point of how to interpret data that you say is unreliable. You think that the housing market data is actually the number one indicator to watch, as you did see pending home sales yesterday come to some of the lowest levels.
I do think it's important. I think what's important about this decline in residential investment that we're seeing right now is that it's coming alongside an ongoing decline in units under construction. That didn't happen last time, right? So there's less building going on. And if there's less building going on, there may be less need for construction workers. Simultaneously, we also know that resale inventories are rising, and that's weighing on home prices. Importantly, it's weighing on prices in the areas where the builders have been making the most homes. So again, that goes back to the construction piece. But again, it's important to kind of understand how the sort of some of these data points, how the sausage is made. I mean, you mentioned the surprise indicator. That's the city economic surprise indicator that you're probably mentioning. If you look at other measures like your own Bloomberg Economic Surprise Index, it doesn't really show that. So it's important to kind of know which indicators to look at and why those numbers are going up. I mean, you saw a very large increase in consumer confidence, and that delta is probably why these surprise indicators moved up. But when you sort of peel back the onion and take a look, the things that actually move more slowly, like labor market conditions, that shows you that things are continuing to get worse.
Neil, I will never look at some of the consumer confidence data in the same way after the punch in the face analogy that you just drew. Neil Dutta of RenMac, thank you so much for being with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Danny.
Hi, Lisa. Israel has accepted a U.S. ceasefire proposal for Gaza, a 60-day pause in fighting with restored UN-led aid distribution. The proposal also includes Hamas releasing 10 live hostages returning the remains of 18 who died in captivity and starting negotiations for a permanent end to the fighting. Hamas has criticized the proposal as one-sided. Hyundai getting ready to raise prices for its U.S. vehicles to cushion the blow from President Trump's tariffs. Sources telling us that the Korean car maker is weighing a 1% price hike for every model in its lineup as soon as next week. The move would apply to newly built vehicles, not those already sitting on dealership lots. And President Trump will hold a news conference with Elon Musk later today at the White House to mark Musk's departure from Doge. In a post on Truth Social last night, Trump said this will be his last day, but not really, because he will always be with us, helping all the way. Elon is terrific. In the past 2 weeks, Musk has sworn off future political donations and criticized Trump's signature tax and spending cut proposal. And that's your brief. Lisa.
Maybe there'll be cupcakes. Danny, thank you so much. Up next, stepping away from the dollar.
There are very good reasons to step away from the dollar. By all logic, Lisa, the dollar should not be where it is. We are seeing that macroeconomic policies in the U.S., especially the fiscal deficit and debt levels, do not show any real discipline by U.S. policymakers.
Steve Englander of Standard Chartered joining us next right now. This is Bloomberg Surveillance. We are getting the first monthly gain for the S&P 500 so far since January, the biggest one-month gain going back to November, with a gain of about 6.2%. We are taking some of that back this morning, but just a little bit, with NASDAQ futures lower by about 0.1%. S&P futures lower as well. If you take a look at the dollar, that has been one of the most interesting trades all year. You are seeing a little bit of dollar strength today, but we have seen about 7.4% decline in the dollar index so far this year as people take a look at whether policies in the U.S. are pushing capital out of the country, not bringing it in. Under surveillance this morning, stepping away from the dollar.
There are very good reasons to step away from the dollar. There simply isn't another currency that can outmuscle the dollar. We've heard very mixed messages from the administration about whether they want a weaker dollar in the short run and a stronger dollar in the long run. By all logic, Lisa, the dollar should not be where it is. We are seeing that macroeconomic policies in the U.S., especially the fiscal deficit and debt levels, do not show any real discipline by U.S. policymakers.
Here is the latest. The dollar edging higher, pairing a fifth month of losses. Steve Englander of Standard Chartered warning of more trouble ahead, saying we think 2026 and beyond may be when the risk of a major dollar move becomes more elevated. The U.S. is increasingly depending on the kindness of strangers. And Steve, those strangers are feeling less kind of late. Why is there not necessarily any kind of problem with the dollar now, but you see next year as possibly bringing a bit more of an issue?
Well, I think the $1 positive that remains is the possibility that the policies work, that they pass the tax bill, they get stronger growth, maybe get some of the productivity effects that they're looking at. And the U.S. is the only game in town. So if I'm a long-term investor, I may have my doubts about the dollar, but I want to wait for those, for those doubts to be confirmed before I start selling, because you don't want to be, upstream without a paddle, having sold your dollar, finding real returns are higher in the U.S. and real interest rates are higher in the U.S. 2026, we'll see the outcome. It might be late in 2026, but we'll see whether these policies have actually succeeded. And if the outcomes are kind of softish, we're going nowhere, we keep talking about stagflation, the question is going to be, we owe a lot of money to the world. Why keep lending to us?
So markets are forward-looking indicators. They're not going to wait until that data comes out. At what point are you going to see possibly a damaging move in the dollar ahead of getting the actual data to back up what you're saying, that maybe we could be expanding our deficit without materially increasing growth?
I think the point would be when the market says, look, the administration's gotten what it's wanted. It's got some tariff revenues, as they said. They passed their big, beautiful bill, and nothing much is happening. And the long end of the bond market may be backing up, saying, well, we don't like the deficit path and debt path that this implies. You look at the growth outcomes, you're sort of beginning to say, we're there, but there's nothing much there.
But if not the U.S., then where do people want to buy those assets?
That's the...
Who fills the void?
No, that's the key question. We're not in 2008 where BRICS were kind of attractive, where Europe was still having its convergence trade. It's not a story of the U.S. getting worse than everyone, but it's a story where the U.S. falls back into the pack. And there's no reason for the dollar to be this strong.
Who's in the pack?
Everybody. China growth is disappointing. European growth is disappointing. Much of Asia has disappointing growth. There's no superstar out there. Perhaps India, but it's not big enough to really carry everything. And that's the issue, that if we live in a world where everyone is growing more slowly and in a disappointing sort of way, the U.S. is there as well. What is the reason to lend so much money? There's a stock problem because we owe, like 80% of GDP. And there's a flow problem that we'll have to keep borrowing 4 or 5% of GDP every year. Who's going to keep those flows going?
You mentioned to Lisa's first question about everything that needs to go right for the administration, the tax bill, the revenues coming in. But do you think potentially, Jensen Huang called it utterly visionary what Trump is doing to try to reshore and reindustrialize the United States. Do you think potentially this administration actually wants to see a weak dollar? They want the exports?
They think they do, but they really don't. And because I'll tell you, there's a path by which a weak dollar signals positive things about the U.S. economy, but it's a very narrow path. Most of the time, the weak dollar path is going to be foreigners don't see value in the U.S. U.S. real rates of return are going down. There's disappointment in equities. That's the weak dollar story, and it's not a house you want to live in.
That said, a number of different countries and regions are trying to bolster their appeal to the international investor in order to get that potential customer. We heard Christine Lagarde of the ECB be very vocal about, all right, this is our chance. Let's get our house in order so people can use the euro as a viable alternative to the dollar. How much do you believe that? Do you see this as a catalyst for other regions to really lay the groundwork for reserve currency status?
I think that there's a possibility Europe looks more attractive. Germany does its fiscal story. European rates converge with the U.S. Everybody's underweight Europe. There's a bit of that. But, when the stores can open on Sunday, when you can hire and fire the way you want, when there's less regulation, I think that will be the brilliant European story. But we've been talking about that for 2 generations now, and it hasn't happened.
When stores open on Sunday, is gold sending a warning signal? We are seeing gold come, say, basically range-bound over the past couple of weeks, but on pace for $75 billion of annual flows, which is a record into gold funds this year.
It is sending a signal, and I think it's sending the signal that there are no great alternatives. But everybody's looking for them. And it could end up being crypto, it could end up being gold. Maybe someone will pull out of the pack and people will fight to get in there. But so far, gold is the only thing that really looks, solid.
What's your, so to speak, what's your gold stash like these days?
My PA trading is not as good as my FX kind of discussion.
Steve Englander of Standard Chartered, thank you so much. I do feel like if you go to people's basement right now, you will see a lot of just shiny things.
Maybe your basement or Jonathan's basement, putting it into suitcases. But Steve's point about Germany is so true. What about when France decides that they're going to get rid of the right to disconnect law? The fact that employers cannot contact you on your time off, work from home, Italy being able to fire. These are structural problems in Europe, which is why many people say, they peaked already.
Yeah, although it sounds nice. Coming up next, Abby Yoder of JPMorgan, Bloomberg's Mike Shepard, Dana Peterson of the Conference Board, and former Chief of Staff to Vice President Mike Pence, Marc Short, as we parse through the fire hose of policy changes and possible events on the horizon. This is Bloomberg.
We don't necessarily want to subject ourselves to too much policy-driven volatility.
The uncertainty that we're all faced as investors hasn't really changed.
The worst case scenario has been avoided. But again, I think this is not an all clear.
Main Street is in a wait and watch moment here.
Sometimes you just have to wait and see.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
We're all numb from policy roulette. Good morning. Welcome back. This is Bloomberg Surveillance for our audience worldwide. John Ferro is on a well-deserved a break. Annmarie, I am struck by how we just keep getting new policy shifts every single day. Markets have stopped really paying that much attention and have moved on to say what is actually going on with the economy, what is actually going on with the consumer.
And we'll find out also as well as how the economy and the hard data is holding up in 90 minutes time when we get that inflation gauge that the Fed is so focused on. When it comes to policy, though, the direction of travel is very clear for this administration. What everyone is concerned about and confused about is the hurdles and bumps along the way. John Stoltzfus this morning, the way you do the things you do, that's the problem he has with what's going on. He sees the end goal, but he's confused with the everyday whiplash and headlines and potentially tariff policy getting caught up in the courts to understand exactly how quickly the administration could present their three-pronged stool.
Yeah, I do believe that he was quoting the Temptation song, which had a very different implication. I believe it was a love song, not necessarily criticism about the road to get certain policy implemented. Right now, we are looking at economic data that has been surprising to the upside. Annmarie, you were talking about how we are going to get a read on the inflation, on income and spending of personal people throughout the country. We're going to be getting that in about an hour and a half. There is a question here about whether the ongoing strength in the economy and companies that are adapting and adjusting can overcome even some of the uncertainty that we're seeing in Washington.
Well, when you look at the conference data and their survey, it looks like people are starting to feel a little bit better. We'll see how that feels with University of Michigan also comes out later today, although that's highly politicized. People are feeling better when the tariff headlines get dialed down. But Neil Dutta says, how many times are you going to punch someone in the face and then you say, I'm not going to punch you anymore? Is the effect still there? Of course they are. And he doesn't think the tariff policy has anything to do with that, and the economy is slowing. We'll get a real read on that next week, of course, when we get the jobs data.
I'm still trying to wrap my head around that. He's saying that people are getting punched in the face, and then if you don't punch them, then they're happy, and then that's basically the rebound that we're seeing in consumer sentiment.
I think he's saying like that slight rebound, but still the damage is done.
Meanwhile, we're looking at markets that are not looking very damaged. We've had about a 6.2% gain so far in the month of May, taking a little bit of heat out of that with about 0.1% decline in the Nasdaq and S&P, a little bit larger in the Russell 2000. But what we have seen is a real numbness right now in markets to potentially negative tariff news, and a real enthusiasm for Nvidia's earnings, for Costco's earnings, and other names that have shown a way to really move beyond. We also have seen strength in the bond market, which is giving a bit of support after a bunch of auctions this week that went surprisingly well. We are seeing a two-year yield in just a touch, but all around somnolent after a pretty wild ride over the past couple of weeks. And then you have, of course, the currency markets, and what a reversal. We actually are seeing dollar strength this morning, even though if you look at the Bloomberg Dollar Spot Index, it's down by about 7.4% for the full year. Coming up this hour, Abby Yoder of JPMorgan Global Wealth Management on a wide range of outcomes for equities, Dana Peterson of the Conference Board on falling CEO confidence, and Marc Short, former Chief of Staff to Vice President Mike Pence on President Trump's trade agenda. We begin this hour, stocks pretty much steady as investors await economic data and trade news. Abby Yoder of JPMorgan writing this. We have widened our year-end 2025 base case range between 5,700 and 6,200 to reflect increased volatility and uncertainty. Abby joins us now for more. Abby, wonderful to have you. Thank you for being here. I am curious if the rally that we've seen so far in the month of May gives you more confidence or less confidence that right now we can eke out more gains.
Well, I'd say more confidence. And like I said, or like what the quote said, we have widened our range because there is a lot of uncertainty. We're not trying to bypass that very, very large fact. But that being said, I think you mentioned this, like what we're hearing from an earnings standpoint, and again, 1Q is backwards looking, but I think, companies have really navigated a very difficult environment for the past 5 years. Like, this isn't new, right? Like, they've had to do this, and even before that, right, 2018 when we had the initial trade war. So I think they're very well equipped to deal with this. We had expanding margins. That wasn't something that I think the market was expecting in 1Q. And so the beat rate was really strong. And I think the outlook, like, while uncertain, is still fundamentally sound heading into what is a more uncertain environment.
You hinted at this. There's a backward-looking element of this, which is this is after companies backlogged a whole host of different products, managed to get ahead of this. How much of this is repeatable going forward?
Well, I think so. Okay, yeah, maybe they did stockpile depending on what industry you were in. But I think what we heard from companies, when you have a framework and a thought process for how, like, okay, this is how we're going to mitigate. It's either going to be, for the price increases, we're going to take depending on whatever industry you're in, whether it's a price taking or price giving industry. Like, they've really laid out a framework for the most part, these high quality companies to work through this. And I think, like, hey, this is where the ranges are. This is what it looks like for us. This is why we have like a wider range of outcomes for the full year. And I think that's testament to how well these companies can be run.
Does the IEEPA court case change any of your thinking?
No, I mean, it was reversed like by the end of the day, right? And I think
it still could be struck down, though.
Yes, it could. That's true, but it doesn't really. The only thing it does is it incrementally, like in the morning, we were talking about incrementally moving closer to our bull case, right? Like and it removes that left tail risk. I think that's an important aspect of this too, and I think a lot of guests have been talking about that. But I think that's the direction of travel where you're not really, because if we think back where we were April 2nd, the market was completely frozen, like, whoa, we're at 28% tariffs and, nobody knows where this is going, who's coming in terms of, like, is it the Fed, is it the president, like, is it the administration? Nobody was doing anything. It was silence for like a week, right? So removing that left tail risk, I think, is important. And our base case had around 15% effective tariff rate. I think that's like the cap at this point, right? Which is a very different narrative.
Do you hope to have more clarity before or after around July 9th?
Well, yeah, I mean, wouldn't we all? Like, that, I think that's important, but also...
No, but do you think we're going to get there?
Oh, yeah, I think so. I think we're working towards that. I think why the market was so muted yesterday, it was originally obviously reacted positively because it looked like these were being removed. And then I was like, oh, wait a minute. This is going to become, a bigger battle where we had already made headway in terms of these other negotiations. And now, like, our counterparties, like, may not want to negotiate because they know this is on the table, that it might be removed. I don't think that I think the administration understands that this uncertainty causes like a slowdown in growth, and they're going to want to work towards a resolution.
There's a feeling in markets right now that policy noise is increasingly becoming noise. It feels like we're all just kind of buffering and getting this sort of, maybe I need just some time to process everything when it comes to the policy changes. Not quite the same when it comes to economic data. We've talked about the company earnings. How much do you think that the economic data is going to actually matter quite a bit more over the next few weeks?
Yeah, so we were thinking about, and this was prior to yesterday, like the way we were thinking about it is you've seen the earnings revisions ratio, which is essentially like a confidence barometer for what's going on in terms of earnings for companies in the S&P 500. That had been steadily moving down throughout, like, leading into the earnings season, and it's stabilized, right? It's still negative, but it's stabilized. And then you started to see it, and this is for the U.S. market, and you've started to incrementally like move higher. And what we were thinking is like, okay, after the pause, on July 9th, depending on what happens, like, you could probably see more downward revisions. Like, now does that get pushed out, right? Because you have seen this resilient economic data. We don't really know what's going to happen in terms of July 9th. So it seems like there actually is more of a floor in terms of the earnings revision ratio that we were waiting for to come down farther in the summer.
I don't want to get too cute here, and I don't want to go back to this phrasing because I think we all are sick of it. But the whole idea of bad news being good news when the bond market starts to actually rally, when that gives a bit of a boost to equities, how much are the returns in the equity space really reliant on the bond market having a bid for whatever reason?
Well, I think it could be, so I think that question gets around like what the biggest risk is, right? Like, I think the biggest risk is like what happens with rates. Like, there's a very, a lot of work has been done, and it looks like the equity market really starts to struggle when the 10-year gets above 450, right? Like, that's like the level that is really difficult, and we've been like hanging out around there. And so I think that's where you get more of a bear case. If you see that, surprise to the upside north of 475, that's not our base case at all. But I think it would be a tailwind for equities that the market's not necessarily expecting to see, the 10-year move lower below that like 430 area.
So this goes to the question of why are yields potentially moving? If they're going lower because of bad economic data, does that really provide a boost? And if they're going higher because of good economic data, how much of a drag is that? This sort of puts the equity market in a bind behind, be careful for what you wish for in the bond market.
Well, I think last time I was on with you guys and I was talking about this, I said, a few months ago, I would have thought the Fed cutting would have been like a net positive for the equity market. But now at this juncture, to your point, I think there would be a digestion period. If the Fed were to all of a sudden be like, oh, we need to cut, it would be because the labor market is deteriorating rather rapidly. policy, the equity market would not take that well. That's like very plain, right? But that would be prior to probably, a rally after that, right? Because the market moves before you get into a recession and before the bad data really comes to fruition.
So where do you put capital in this moment?
So we think we have a preference for financials and software within the U.S. And utilities. I think financials is really interesting, right? Because that was kind of like a consensus long coming into the year, and then it kind of paired off because there was no, capital markets activity, no M&A. You've started to see that kind of pick up over the past couple of weeks. Like the past 3 weeks, you've seen some green shoots there, and then underneath the surface, you also, some of it's well known, like SLR reform in August, but what happens with the CCAR test reform, what happens with G-sub surcharges. I think that stuff is really interesting, and there's a wide range of outcomes in terms of what goes on. But the direction of travel for this administration is to deregulate, and they have $200 billion in excess capital, right, to deploy into M&A, to loans, to buybacks. So I think that's an interesting story.
Are you stockpiling gold in your basement?
Not yet, no.
Okay, Abby Yoder of
I think you're the only one that's doing that.
Is sticking with us. I wish I were doing that. I don't think that I
good deal at Costco.
Have a basement. Yeah, I heard that was the case, and I heard that John actually took. Yeah, exactly. Welcome to the city. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Danny.
Thanks, Lisa. Harvard University has won a longer-term reprieve from a Trump administration ban on enrolling international students. Harvard sued the administration last week, claiming the ban was illegal. At a hearing in a Boston court, a U.S. district judge extended the temporary pause that she had put in place. The Justice Department has asked a federal judge to dismiss its criminal case against Boeing after the 2 fatal crashes of its 737 MAX jets. The reversal in the long-running case over the disasters in 2018 and 2019 comes despite objections from some family members of the 346 people killed. Hyundai is getting ready to raise prices across the board for its U.S. vehicles to cushion the blow from President Trump's tariffs. Sources telling us that the Korean car maker is weighing a 1% price hike as soon as next week. The move would apply to newly built vehicles, not those already sitting on dealership lots. And that's your Bloomberg Brief. Lisa.
Thank you so much, Danny. Another reason why people are trying to buy ahead of those price increases. Up next, stalled talks with China.
What about China? How can you characterize those talks now?
I would say that they are a bit stalled. I believe we may at some point have a call between the president and party chair Xi.
Coming up, Bloomberg's Mike Shepard joining us next. This is Bloomberg. Tempered morning after a month of gains, which is unusual for 2025, 6.2% gains for the month of May. We have actually turned positive, and just so, on the NASDAQ 100. This is what we have seen pretty much steadily throughout the different trading sessions. We could start out soft, but we get that pop. In the bond market, you're not seeing much action, which is a good and beautiful thing and news unto itself. You are seeing the front end lower by just a touch. And yesterday, you actually saw people price in 2 full rate cuts for the first time in a while after some of the data that came out that showed weaker consumer spending as well as potentially softer inflation. Under surveillance this morning, stalled talks with China.
What about China? How can you characterize those talks now?
I would say that they are a bit stalled. I believe that we will be having more talks with them in the next few weeks, and I believe we may at some point have a call between the president and party chair Xi.
Here's the latest. Treasury Secretary Scott Bessent confirming the trade talks with China have slowed despite making progress with other countries. Bloomberg's Mike Shepard joining us now. Mike, thanks so much for coming back with us. Let's just start with that call potentially between President Trump and Xi Jinping. What would it take to get that to happen?
Well, they really need to make that outreach. And in a way, this was a message from Scott Bessent to Beijing that, hey, we're here, we're ready for a call. Now, the question is who picks up the phone. Right now, the mood and the direction of travel for China is not moving in the U.S. favor. They're seeing a lot of moves by the U.S. government that really run counter to what Beijing sees as the spirit of those discussions in Geneva that got both countries to walk back the super high levels of tariffs that they had imposed in a tit-for-tat fashion in recent months. Now, to get them to speak, it would really take a little bit more outreach, perhaps by Scott Bessent, and perhaps a walkback of some of the tougher moves that the administration has been making. This includes in the area of export controls, and this also includes the targeting of Chinese students here in the U.S. by moving to revoke some visas.
Is basically the talks on stall because of other issues, Mike, outside of trade and tariffs?
Well, I think you hit the nail on the head there, Anne-Marie, because China has been really objecting to, for the past several years, an escalating series of tech-related export controls. The U.S. has been trying to deny China and Chinese companies the ability to develop advanced technology on their own, especially in the area of AI. It involves limits on sales of sophisticated semiconductors to China, but also sales of equipment needed to make semiconductors. So this has been a global pressure campaign against American trading partners, warning them not to sell that sophisticated gear to China. This has really set Beijing off because they are trying to build their own domestic industry, and they need imports of that advanced technology to help make that happen. And we just saw today a scoop move just in the last hour that Beijing is planning to invest as much as $70 billion toward this kind of an effort to enhance its tech and artificial intelligence infrastructure. So these sorts of moves in terms of export controls and other areas have estranged the two sides just as they're trying to reach this rapprochement over tariffs. But for China, it is much more than just about tariffs here, really.
Shep, it seems like there's some daylight between Jensen Huang of NVIDIA and President Trump when it comes to understanding what is necessary for the U.S. to have the upper hand when it comes to technological prowess. Are we seeing anyone within the administration move to the Jensen Huang side of things, where he's looking at potentially the need to stay ahead of China by being engaged with China because they are already rapidly improving their technology to be almost on par with what we have in the United States?
That's a great question, Lisa, because we have been hearing increasingly from Jensen Huang, the head of NVIDIA, especially since the administration moved ahead with its plans to tighten export controls on China and targeting the H20 chip that was designed specifically by NVIDIA to serve the Chinese market and still meet previous rounds of U.S. export controls. This is a huge market for NVIDIA, and it's a big area of concern for them. He said during their earnings call that they took a $4.5 billion write-down just on those H20 chips, and they're concerned about losing access to this market. And his argument is that, look, China is going to develop this technology with or without us, and we need an American presence and an American footprint in there. And if we walk away, China will innovate on its own. And there is some agreement in the Trump administration that the export controls that we had seen imposed increasingly during the Biden administration maybe had gone too far, but that was in relation to other U.S. trading partners and not China. And that's really where the administration and Jensen Huang part ways. There is still a very China hawkish view in Washington and definitely within the administration that would make it hard to see anyone come aboard and say, OK, we're going to loosen all these controls that we have spent years building.
Mike Shepard of Bloomberg, thank you so much for your time and really concise and important synopsis there. Abby Yoder of JPMorgan still with us. Abby, I want to go to that point, this question of whether the market is being overly complacent about the idea of decoupling between the U.S. and China and what that will do to the American exceptionalism trade in big tech.
Well, so I think, like Mike mentioned, this has been something that's like the export controls have been building since 2018 under the first Trump administration, then also under the Biden administration. Excuse me. And I do think this is an area of national security. We hadn't even really had the sectoral tariffs come out from the administration, but this is part of the reason we became a little less enthusiastic about semiconductors in particular starting last year, just because they're just kind of in the crosshairs of what is going on between this decoupling, right? And I think this is a real race for AI, and I think it's interesting to hear that China is like, really wants our tech and they need our tech, because DeepSeek was kind of the argument that they didn't need it, right? Like that they didn't need the newest and latest. And I know the H20 isn't necessarily like the newest and latest, but I think that is an interesting thing where this really is a race, but there's also, and we're at the forefront of it, right? So we're back to that conversation that we were pre-DeepSeek. And I think, this is a race that we're trying to win from like a technological standpoint, but also from a national security standpoint. So it just seems very hard to see that de-escalating.
Since April 8th, the NASDAQ is up by 26%. Is that an excuse to sell it, given the overhang of some of these issues?
So this speaks to the NASDAQ, this speaks to the overall S&P, because obviously there's a lot of exposure to these tech and Mag 7 companies. Like the Mag 7 beat earnings by almost 30% this quarter. There was like zero expectation for that. That's the best beat rate in 2 years. So that's just, I think it's like, I think before I came, when I was on last, like they hadn't reported yet, and it was like, this was the consensus trade for the past 2 years. We were still really behind it, and now it's working again. And it's like, I just don't think that you can't own these names. I think between the S&P and I think it should be through, more. I don't think they're a monolith, right? Like there's differentiation between all of them, but I do think they are at the forefront of not only, the fastest EPS growth, but like they're driving the margin expansion, and it's going to go beyond them to the rest of the market within the U.S. So I just don't think
What sectors do you think are going to benefit when it goes to the rest of the market?
I mean, I hate to keep harping on financials, but I do think, financials really do stand out as like one of those, sectors that has this very high expense, but like that can be kind of automated in certain ways.
Like the Anthropic report that basically all these entry-level positions, especially at banks and financial firms, are basically going to be out the window because we're just going to replace them with AI.
Well, and I was wondering, thinking about like what Neil was saying earlier today, like, is that spike in like continued unemployment claims is that related and concentrated in these younger individuals who can't seem to find a job? Like I think that's, and the story is that this is happening underneath the surface, and like there isn't a huge amount of, focus on it at the moment, but it's going to come to fruition over the next, it sounds like 12 to 18 months.
Just to finish up on the idea of how you, as an investor, handle all of the trade headlines, the sort of roulette that we keep getting. Do you have indexes? Do you have ChatGPT screens to see what exactly the words are that might actually make a difference, or do you just ignore it?
The trade headlines? Well, we do have an internal ChatGPT or LLM, but we're focused on fundamentals. Like, yes, we pay attention to what's being said in a lot of these things, particularly, we didn't even talk about this, the reconciliation bill and like what that means from a positive standpoint. But for the most part, like we're fundamental investors. We're going to be focusing on what's happening with the companies and really what they're saying, more so than like, and how they're navigating this environment than we are necessarily. And again, what can happen from a policy standpoint can change any minute, so that's more difficult.
Avi Yoder of JPMorgan, thank you so much for being with us. Avi Yoder of JPMorgan Global Wealth Management, at a time where increasingly that's what we keep hearing, that if you just get a different headline every day and sometimes within hours, look elsewhere.
But nothing's changed because the direction of travel is consistent. I love what Neil Dutta said yesterday in his note. Tariffs are a dial, not an on and off switch. And if you think the judiciary gets to be the one to turn the knob, seek help. The administration has an agenda, and they are going to pursue it. It just might be bumps and detours of how exactly they pursue it.
Meanwhile, we're going to be talking about the economic data and what that is telling us about what's actually happening on the ground. Coming up, Dana Peterson of the Conference Board on falling CEO confidence. Watch that, because that, I think a lot of people are watching to understand what are executives doing with this, how much are they putting off some of their capital expenditure plans, and what are their hiring plans like, not just ChatGPT, but beyond. This is Bloomberg. Clawing back a lot of the losses from earlier this morning, possibly, let's wait for it, see if we can add to the gains that we've seen already this month. Basically flat across the board, S&P futures and NASDAQ futures down less than 0.1%. The bond market also quiet. And what this is telling you is that the volatility in trade headlines is not making a dent when it comes to traders that have seen it all and are kind of done listening and being whipsawed, at least for the moment. 2 hours away from the cash open, here are your morning movers with Danny Berger. Danny.
Hey, Lisa. Regeneron falling in the pre-market trade. It had an experimental lung disease drug that it was partnering with Sanofi to do. It ran some tests, some trials on them. Mixed results. Some of them showed improvements, some of them didn't. And that's going to set them back. They say they're still analyzing the data, but those shares down 9% in the pre-market. Also down in the pre-market. Gap reporting earnings yesterday, talking about a $300 million hit that they're going to see because of tariffs. It did say it could offset half that cost, but the figure itself a surprise to markets, and you're seeing shares down a really, really large extent, down 15%. It did have some solid results when it came to Gap and Old Navy brands, but some of their other brands did see sales fall. Now, where consumers are spending is makeup. Ulta, the makeup chain, really strong results. It beat on basically all of its metrics. It uplifted its profit for the entirety of the year. Those shares up 8.2%. I wrote down this quote from the CEO because I loved it so much. The CEO said in the earnings, many customers are leaning into the beauty industry as a comfort and escape from the stress of macro uncertainty. So Lisa, worried about tariffs, I guess make yourself feel better and go buy a blush.
And get yourself beautiful. Danny, thank you so much. I really appreciate it. We saw that during the pandemic, although people said it was because of Zoom and the fact that people wanted to look good. But makeup seems to be the trend that just won't die.
When I was living in Europe, I used to go interview the L'Oreal CEO, Jean-Paul Agon, and he would talk about the lipstick effect. If there's any sort of downturn or nervousness and anxiety, you go out, you treat yourself to something small, affordable, and it's lipstick.
Yeah, my grandmother, whenever she was stressed out, hairspray. On our radar this morning, President Trump's tariff agenda getting a legal reprieve. A federal appeals court granting a temporary stay from a ruling threatening to throw out the bulk of his Liberation Day tariffs. How much have we actually learned, Annmarie?
Well, a lot of noise, and we haven't really learned a lot because the tariffs are staying, and the question mark is, will they stay under IEEPA, or will the administration have to find different avenues to get to the same end goal? And the Wall Street Journal front page this morning talks about that, this twofold approach. They likely will use Section 122, which we spoke to Peter Navarro yesterday about, and he said, basically, nothing's changed. The administration is aware of this, and he basically gave credence to the fact that they could use this as a bridge to then get to using other trade provisions, whether it's 301, 232, if they're going to go after countries or sectors that are more legally sound.
There is a time element here. Time is of the essence. There is a goal in the administration to try to get some of these tariffs and trade negotiations done in time for the midterm, so you can see the effects and it can actually be positive. Do we have a sense of how much of a roadblock some of these court cases introduce with respect to the timing?
Well, forget the midterms. They have a self-imposed deadline of July 9th. I think of trade in two parts, though. It's everyone, and then there's China. So putting China to the side, 'cause that's going to be a really long slog, and the Treasury Secretary talked about this stall. Everyone else, they want to get to July 9th. So I view this court case as really just noise, because even if the court comes in June and strikes all of this down, goes to the Supreme Court, we have this advanced decision, by July 9th, they could still use Section 122 and have at minimum, maximum of 15% tariff on everyone for 150 days while they figure out these trade deals.
In the meantime, let's talk about China. Treasury Secretary Scott Bessent saying trade talks with China are, quote, a bit stalled. Bessent added that President Trump may need to hold a phone call with Chinese President Xi Jinping to get negotiations back on track.
What I find so interesting is I was in the Oval Office with the president before these Geneva talks, and I asked about this, and he seemed pretty willing once again to get on the phone with Xi Jinping. So it's interesting that that call has not happened yet. For that call to happen, there would likely need to be more details of a potential grand deal that these two countries could have. And to Mike Shepard's point, it is not trade or tariffs that holding this story back, and I agree with him. It's the fact that the U.S. is coming out with more aggressive stance on chips, potentially jet engines they want to revoke going to China, as well as visas. They were revoking visas for Chinese students. All of this is adding to a lot more animosity after we had that détente in Geneva.
I just am waiting for us to talk about who's going to call who and who's waiting by the phone.
Who makes the first call?
To try to understand the dynamic of this. The president set to hold a press conference this afternoon alongside Elon Musk, marking the first buddy's departure from his role in the administration leading Doge. Trump saying on Truth Social, quote, this will be his last day, but not really, because he will always be with us, helping all the way. There have been questions about the future of Doge. There are questions about whether this is just a goodbye party. What is the purpose of this press conference?
I don't think it's a press conference. I agree with you. I do think it's a little bit of a goodbye party. What I would say is the president talking about there, something Scott Bessent really echoed last night in this interview with Bret Baier. The fact that the way of thinking when it comes to cost cutting and trying to make the government more efficient, even though Elon Musk came to the inauguration, was on stage with a chainsaw and talking about for weeks, I'm going to cut $2 trillion. Obviously, we're a far cry from that. But it's this ethos that Scott Bessent was talking about, the Treasury Secretary, of making the government more efficient. They want to keep that. So Elon Musk, of course, he only had a certain amount of days. He was the special government employee. But I imagine he's going to stay within the president's orbit, even if we do see some distance put in place.
I'm curious to see how they discuss some of those cost-cutting measures and what the future looks like at a time when we've had a lot of conflicting news about just how much and how deep those cuts have been. In the meantime, as Abby Yoder was saying, a lot of investors are really watching what company CEOs have to say, and the Conference Board's measure of CEO confidence fell to its lowest level since Q4 of 2022, seeing the largest quarter-over-quarter decline in nearly 50 years. According to the survey, the majority of CEOs are bracing for a recession in the next 12 to 18 months. Dana Peterson of the Conference Board joins us now. Dana, thank you so much for being with us. I want to talk about how surprised you were to see this data, given the fact that a lot of sentiment data among consumers has been ticking up, and we have gotten pretty good results in terms of earnings from a lot of companies.
Well, I wasn't terribly surprised. Certainly since the beginning of the year, there's been a lot of volatility coming out of Washington in terms of policies around trade, around regulation and spending. And I think it just really spooked many CEOs, especially those who are very dependent upon trade for their businesses. And so we did notice that for the responses that were before May 12th, where we had this detente between China and the U.S. on trade, and those afterwards, the ones afterwards were a little better, but they were still negative.
The idea of how to read this and how much of a forward indicator these surveys traditionally have been, how much has the CEO confidence index really been something of a harbinger of a change in economic trajectory versus kind of noise, the way that we have seen a lot of the consumer confidence surveys?
Well, since we've been doing this almost 50 years, when the measure drops below 50, which is, that means it's pessimism as opposed to optimism, it has done a pretty good job of signaling recession. Now, when we look at the measure today versus what it did back in 2022, late 2022, early 2023, we saw similar numbers where many CEOs were afraid that there was going to be a short and shallow recession. We didn't get a short and shallow recession because consumers continued to work. And the reason why is because companies didn't let them go. Companies cut elsewhere. And we think that, certainly this time around, there's just a lot of noise, a lot of volatility, and it really spooked a lot of CEOs. We still hear a lot of them saying, well, we're going to raise prices, because these tariffs are going to affect us. But we haven't heard much about them saying they're going to let people go. Still in all, if we do see these tariffs stay and even intensify, with some of these other investigations, that you may see some unemployment rates rise.
Well, I found most interesting about the survey that most CEOs anticipate no change at all in the size of their workforce for the next 12 months. So doesn't that show that they can weather this storm?
I think so, but we also need to remember that there's still labor shortages going on. You still have many, many people, thousands of people retiring every day, and you have, younger workers, but they have less experience. So I think that, that story is still there. That narrative is still there. Where companies will cut other places, cut investment, because indeed the investment measures were worse, and they'll raise prices, but they're not going to let go of their workers.
We have almost mixed reviews when it comes to corporate America in terms of how they're dealing with the tariffs. Costco yesterday, they're sourcing more locally produced mattresses and pillows, and they seem to be weathering this brilliantly almost. Gap, though, on the other hand, they're anticipating as much as $300 million in a tariff impact. But I want to get a sense from you. Do you think corporate America is using tariffs sometimes as an excuse for other issues in their business?
That's always possible, but I would say in general that most companies and CEOs understand what tariffs are. Tariffs are a tax on their imports, and they're not going to absorb those costs. And so they just keep passing it down to the wholesaler, to the retailer, and ultimately the customer. And so, retailers that sell clothing, most clothing is not made here in the U.S. So it makes absolute sense that they'd be more nervous versus maybe other types of entities that can source things from the United States. So I think that, maybe some companies may use it as an excuse, but in general, this is a real thing. This is a real risk for many companies. And, they have to figure out a way to weather this. And a lot of it is going to be to raise prices.
Dana, coming into this year, there was a tremendous amount of optimism, and companies were talking about CapEx spending, mergers, acquisitions. Do we have a sense on a holistic level of how much they've ratcheted those back in a more sort of sustained way as a result of some of the policy uncertainty?
Sure. At the beginning of the year, I think a lot of companies were anticipating deregulation, maybe some tax cuts for corporations. And then, the script flipped and we were, less worried about that. And I mean, those kinds of benefits faded away with the trade wars. And we did notice that there was a dip in the number of CEOs saying that they were going to increase their CapEx investments. But I think many companies are on pause. They're waiting to see what's going to happen. And unless you have some kind of long-term project where, politics doesn't matter as much, I think a lot of companies are going to remain on hold until they see what's really going to happen. And also, a number of companies are probably concerned about demand destruction. We think we're actually going to see some weakness in consumer spending, maybe even starting in the most recent data, but certainly in the third quarter. And that's going to be very gnarly for many CEOs and many companies.
Dana Peterson of the Conference Board, thank you so much for being with us. And right now, we are awaiting in less than an hour time personal income, personal spending, real personal spending, which will be interesting, as well as core PCE. Right now, let's get you an update on stories elsewhere. This is your Bloomberg Brief with Danny Berger. Danny.
Thanks, Lisa. Costco, as Anne-Marie was mentioning, reported better than expected earnings in the third quarter. The nation's largest club chain is taking steps to navigate tariffs. That includes rerouting goods, sourcing more locally produced items, and examining potential price changes on an item-by-item basis. Costco shares are up more than 20% over the last year. Toyota will start producing 2 American-made all-electric models next year, adding to the company's existing EV lineup. The Japanese automaker wants to have a total of 7 EVs on display in its U.S. dealerships by 2027. The new battery-powered cars will help fulfill Toyota's pledge to offer an electrified option for every model it makes globally by this year. Apollo partnering with JPMorgan, Goldman Sachs, and 3 other banks to trade private credit, a syndicate investment-grade debt. Sources telling us that the partnership will allow Apollo to originate larger loans faster and support its efforts to reach individual clients. Apollo and other fund managers see the $1.7 trillion private credit market as still in the early stage of explosive growth. And that's your brief, Lisa.
Thank you so much, Danny. Up next, sticking with Plan A.
The tariffs remain in place. The court told us, go do it another way. Oh, there's no Plan B, it's Plan A, okay? Plan A encompasses all strategic options.
Marc Short, the former chief of staff to Vice President Mike Pence, joins us next. This is Bloomberg Surveillance. It has been a different kind of month than what we've seen over the past few months. We have seen the first month of gains going back to January, and what we are seeing this morning is possibly maybe going to build on them. We have clawed back some of the gains that we saw earlier into a negative territory. The Nasdaq and the S&P lower by 0.1%. Still very quiet in the bond market, also quiet with yields on the front end lower as people look to potentially more Fed cuts on the heels of weaker than expected inflation data as well as personal spending. Under surveillance this morning, sticking with Plan A.
The tariffs remain in place. The court told us, go do it another way. So you can assume that even if we lose, we will do it another way. And I can assure the American people that the Trump tariff agenda is alive, well, healthy, and will be implemented. Oh, there's no Plan B, it's Plan A, okay? Plan A encompasses all strategic options.
Here's the latest. A ruling against President Donald Trump's Liberation Day tariffs could be taken up by the Supreme Court as soon as today. Another tariff setback could threaten $2 trillion in revenue. The Republicans on Capitol Hill are counting on. Bloomberg's Enda Curran joins us now for more. And what do we know about how important this type of revenue really is and how big it could potentially be with or the whole if these tariffs are not allowed to go through?
Yeah, well, on paper, if the original court ruling is held up, Lisa, there is a lot of revenue at stake here. You have Wall Street banks like Goldman and Citi estimating maybe $200 billion a year. Projections in terms of money that could be raised from tariffs would be at risk. You've got the Yale Budget Lab, who extends their forecast over a decade, saying there could be $2 trillion there taken off the table if the original court ruling is held up. So remember, getting revenue from tariffs is a central part of the administration's economic policy, and of course that's feeding into the tax bill that's going through Congress at the moment. As I say, that's on paper right now, but of course, we have to see how the appeals process goes. We know that tariffs remain in place. You hear the White House officials saying they're not going to take a step back. This remains very much their strategy. And then even outside of that legal process, of course, the administration has other options, as we know, the world of sectoral tariffs, other parts of the Trade Act that they could use to ultimately raise the revenue that they need from tariffs. But, right here, right now, the narrative from the White House has been these tariffs will raise significant funds for the administration. There are now, at the very least, there are now question marks over ultimately how much revenue they will raise from this tariffs process.
Great perspective. Enda Curran of Bloomberg, thank you so much for that. Marc Short, former White House legislative director and former chief of staff to Vice President Mike Pence, joins us now. I'm curious, Marc, from your perspective, how different the policies of Trump 2.0 are than the policies of Trump 1.0, which you were intimately involved with.
Well, thanks, Lisa, for having me. I think that the Trump 2.0 policies are dramatically different. I think that the president has basically eschewed most of the conservatives who were around him in the first administration, and it's a far more populist agenda this time, particularly as it comes to trade. I think in the first administration, sure, there were limited tariffs on steel and aluminum, but predominantly it was rallying the globe against China and isolating China with tariffs. What you saw out of the gate with this administration was across-the-board tariffs, which the court, obviously repudiated this week. But it goes back to this notion that you even saw with Peter articulating, which is one that you want to try to build a moat around the United States and basically assess tariffs not just for national security reasons against China, but claiming because of trade deficits or claiming because of currency imbalances. I mean, today America exports more than ever before, but that's not a message you hear from the administration. What you hear them saying is that we're going to assess tariffs to try to get manufacturing jobs back into America.
But don't you think the administration is taking this aggressive approach so Trump himself has leverage at the table?
I think that this is one of the few positions that the president has consistently had throughout. I think there's been a lot of other positions he's showed a willingness to negotiate on. But when it comes to trade, it is his core belief. And I think that you're going to continue to see him, as you said, dial it up and dial it back. And I think he wants that tool in his hands and not something that the Constitution says belongs to Congress as the ability to assess taxes. And so, yes, I think there's been no president in American history that's ever tried to use IEEPA for the notion of using broad-based tariffs. But I think you'll continue to see the administration say, okay, well, then we'll do it under 232 or do it under 301 until the courts relent on those two. They're going to continue to try to push it at every angle they can.
Do you view all these trade talks and negotiations really about trade, or is it also about more investment? The president just went to the Middle East. He inked all these deals. He wants to see companies invest in America. And we see a number of companies try to basically cozy up to the United States and countries talking about how much they're willing to build in the U.S.
I mean, I think it's both, and I think that the president deserves credit for some of those deals. But I think in many cases, those are probably deals that were already in the works, that those countries know if they can give president credit for that, then perhaps he'll give them more relief on tariffs. So I think it's twofold. In some cases, I think it's other nations announcing some sort of vague investment deal in the United States, believing that will give the administration a little more flexibility in what they assess as far as tariffs.
You were the legislative director under Trump's first administration. For those that are not used to Washington speak, you basically shepherded through the first Trump tax plan, TCJA, and we're going to see the extension of that potentially. What are you expecting the Senate to change in this bill sent over by the House?
I think you'll see some a little bit of changes, but I don't think it's going to be significant, Marie. I think the reality is that the vote in the House of 215 to 214, it doesn't have a lot of margin to change this bill significantly. I think there's some senators who want to see more cuts. I think they're going to see other senators who don't want to see as many cuts in things like the Biden IRA bill. And so I think you'll see some negotiation, but at the end of the day, I suspect that what ultimately comes out is pretty similar to what the House passed.
How serious do you think this administration is about, I don't want to say the Mar-a-Lago Accord, but some of the provisions in that? And I'm talking in particular in the legislation. There is one section that's getting a lot of attention in bond markets in particular. It's Section 899, which would tax certain investments in the United States from foreign investors tied to particular countries that have VAT taxes, that tax some of the technology coming from the U.S. What do you make of that?
I think it's one of the things you will see probably change in the Senate. I think that there's a lot of, I think, tax gimmicks that were candidly in the first bill here that they advanced to the House that the president articulated, like the no tax on tips. And again, I'm not sure how many people who get their income predominantly on tips actually pay taxes. I think when you look at some of the things like reducing deduction or adding a deduction for automobiles made in America, there's a lot of these kind of gimmicky initiatives to advance a broader narrative that the president wants. But I don't think that you'll probably see those survive the Senate.
You know how the sausage is made, and you talked about how when you were there, it was much more of a conservative fiscal approach. You said this is much more populist. And I wonder about that battle on Capitol Hill right now with Republicans who are more traditionally conservative and those who are more populist, and then how much that battle is being quieted by the overlay of allegiance to Trump. What do you make of that?
Well, an example was last night, the president's tweet against Leonard Leo. I mean, Leonard was one of the founders of Federalist Society that I think wasn't just one of the biggest contributors to the president's advancement of conservative judges. It actually, if you remember in 2016, the president came forward and said, here's my list of 21 potential nominees to the Supreme Court. That was formulated by the Federalist Society. Much of what the president's accomplishment on the judicial front was because of Leonard and the Federalist Society. And so it's just the latest iteration of him moving away from conservatives and advancing a more strictly populist approach. When it comes to the Senate and Congress, Lisa, I think the reality is there are more conservatives, but they're reluctant to speak out because they know the president has such dominant control over our party right now. They don't want to get primaried. And so even though in private they may express traditionally conservative viewpoints, they advocate publicly in an allegiance with the president's populist agenda.
Marc Short, really wonderful to have you. Thank you so much for being with us. Marc Short, the former chief of staff to Vice President Mike Pence. Thank you so much. Coming up, Greg Boutle of BNP Paribas, United Airlines Executive Vice President Andrew Nocella, Lindsey Piegza of Stifel, and Chanel Desai of Franklin Templeton as we try to wrap our head around what companies are saying, what policy is saying, and how much the economic data is a clean read versus a distortion of front loading and consumers that still have money to spend. This is Bloomberg.
There is not an all clear from a tariff policy perspective.
We know the administration is going to push back. They're going to push back hard.
The tariff levels that we had yesterday are probably going to be the tariff levels that we have tomorrow.
It would be a little bit foolish for countries to just assume that this is over.
The worst case is definitely off the table, no matter what happens in the court case.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back. This is Friday after a long week, after even a shortened long week, and a long month that we ended up with something that looks like potentially the biggest gain going back to November, a 6% gain in the S&P 500. A lot of people looking past the policy roulette, moving toward this question of what the economic data will show at a time when potentially we could be getting some weaker than expected inflation, which will be a bout of good news. Annmarie, I think it's very notable that after all the turmoil in trade, Jerome Powell had his first visit to the White House in person to meet with President Trump yesterday, where the president said it is time to cut rates. And the Fed chair said, we are watching the data.
We're watching the data, and he's going to be watching the data when it drops in about 29 minutes time, of course. Right now, what the administration wants to see is better inflation data, lower gas prices, and they think that will be enough for the Fed and should already be enough for the Fed to start cutting interest rates. The issue, of course, for Jay Powell is he's looking at what we've been living, Lisa, for the past few months and really on high alert the past 24 hours on where the president's trade policy is going. Is it going to get stuck in the courts? And what does that mean for the direction of travel, even though we do know what the end destination is?
We do get personal income. We do get personal spending. We also get core PCE coming up in about a half an hour time. And there is this feeling that the consumer is resilient, softening but resilient. We've heard from Costco how they're adapting and adjusting. We've heard from Walmart about how they're doing the same. NVIDIA seeing better than expected earnings. Abby Yoder on earlier talking about how we have seen a 30% beat for the large tech companies at a time where nobody was expecting that. How much is that giving some wiggle room to the president to kind of go hard with some of these policies?
Well, potentially it does give him wiggle room, but at the same time, this administration is moving ahead when it comes to trade deals. The Treasury Secretary said last night on Fox News that this morning, today, he's going to have a massive Chinese delegation in his office today. Yesterday, Kevin Hassett talked about the fact that there are 3 trade deals that could potentially be announced very soon. They have this July 9th self-imposed deadline, which is why I think it's so interesting with the courts. Almost that is just strictly noise. If they're going to stick to the July 9th deadline, then it doesn't matter what the courts come out with.
Meanwhile, we are drumbeating to next Friday, which is the jobs report. Today, we do get a number of data points at 8:30 in about 28 minutes time. And then we get the University of Michigan sentiment survey. We have, of course, initial jobless claims next Thursday. Super interesting after yesterday's continuing claims that rise to the highest level going back to 2021. And of course, we do also get a whole host, I'm sure, of additional policy headlines. Right now, markets clawing back a little bit after that 6% gain for the month of May. You can see bond yields pretty quiet as people look to stronger than expected auctions and weaker than expected consumer spending. Coming up this hour, Greg Boutle of BNP Paribas. As the stock rally pauses, Andrew Nocella of United Airlines on the summer outlook for travel, and Lindsey Piegza of Stifel ahead of another read on the inflation and the consumer. We begin this hour with stocks steady as President Trump's tariff agenda faces court battles and slow-moving negotiations. Greg Boutle of BNP Paribas writing, quote, reduced tariffs could potentially be good for risk. However, recent news has massively increased uncertainty. Greg joins us now. Greg, welcome. Great to see you. Happy Friday. There is a feeling that nothing has changed after this week's turmoil in the court system over tariffs. You disagree and think it does increase uncertainty. Why?
So I think there's a lot of uncertainty as to how the tariff uncertainty manifests in terms of the macro data. And this has increased the uncertainty of how the tariffs are potentially deployed and the timing of those. So we think that uncertainty is the theme for the market, and we think it's going to start to become a headwind for equities here.
So you think that this is an opportunity potentially to sell and get bearish, or you think that this is just volatility that widens the range, as we hear so many people say?
Yeah, so we think there's some asymmetry in the market. So it's not necessarily about being outright short the market, but it's about owning the left tail of it. So when we look at the equity market, we see more risks on the downside than the upside. We certainly think there's a risk that we could tread water through the summer months. We titled our note yesterday, Tariff Fatigue. We think everyone is tired of the kind of continued headlines, and the market is starting to become less reactive, and we saw that yesterday, to the incremental headlines. So we do think there is a risk that the market treads water through the summer before some of those potential deadlines in July and August, and potentially a softening of the data change the course.
Why do you think more uncertainty with this court case if the direction of travel is staying the same?
So I think the path, the timing of it are things that are uncertain to us. So there's a raft of macro data next week, but is that data that comes too early? Should we look through it? Are the deadlines that we're looking for the 90-day expiry in July? Or are we looking out to August where that China window ends? For those of us who traffic a lot in the options market, the timing of things is as important as the end destination, and we think this has just increased the uncertainty as to...
So you think that July 9th deadline, though, do you start to bake in that they will get these trade deals done? We are hearing that from Kevin Hassett and the Treasury Secretary.
No, not necessarily. So I think it's a potential stumbling block, a point of uncertainty. So when we're looking at the options landscape, we don't see an awful lot of premium priced in for any of these specific dates. So we think there's value in owning optionality that spans those potential windows, rather than the kind of shorter dated optionality that we think might be more difficult to carry.
So really treading water. Where do you see option pricing on specific dates? What is the market excited about?
So I think there's some interesting nuance in it. You know, when we look to things like the US listed China ETFs, we see implied option values as low as they have been in the last 6 months. So there's a lack of fear, a lack of panic, particularly on the downside of that optionality complex. You can compare that to the US index options, and even though the market is kind of within touching distance of those all-time highs, there is still a decent premium baked into both the at-the-money optionality, but particularly the downside.
We've seen economic data points lose relevance over the past couple of weeks as people say it's really distorted, noisy, has a lot of front-loading effects that are baked in. Does that start to matter more as potentially you have this push-pull of both soft economic data rising up to the hard data as well as ongoing caution from a number of CEOs?
Yeah, exactly. So that dichotomy between the soft and the hard, both in terms of the macro data, but also the earnings is going to be important. And that's why the passage of time matters. Like, we can look through some of the data, even though there's a lot of important macro data next week. It wouldn't surprise me if the market looks through it. But as we get through June, July, then we start to move into that world where the tariff impact, if there is one in terms of the data, should start to manifest. So we think the timing of it, the sequencing of it is important. And as we get through the summer months, June, July, August, we expect to see that manifest more in both the macro, but also the earnings.
We've been asking all morning whether the rally that we saw in May gave you more confidence or less confidence in equities going up in the United States. A number of guests have said, actually, it's given them more confidence because you've seen accompanying earnings that have been really positive. It sounds like you disagree.
Yeah, I do disagree a little bit with that. I don't think there's so much that you can read from it. I think the earnings are backward-looking. So the earnings that we've seen haven't necessarily worried me, but I don't think they're that relevant for the risks that we see for the market. I think in terms of the rally we've seen, a huge amount of it has been driven by positioning. We've seen massive imbalances in some of the flows that we see in the market, both from the option market, the rebalance of some of the levered products, CTAs, vol targets, some of these systematic pockets of the market have had a hugely disproportionate impact, both in terms of the initial sell-off that we saw post-Liberation Day, but also the amplitude of the rally. So I think reading too much into either the backward-looking earnings or the price action for the last month, I think is a bit dangerous.
Yeah, these have been really tough signals to read. And I was looking at some of the flows data from EPFR that came in overnight, and it showed that U.S. equities saw a second straight week of outflows, of withdrawals. And even as you saw inflows into places like Europe, you saw inflows to gold. You saw the classic sort of safe haven trades. I just wonder what you make of flows versus price action, how you judge that and put it against one another.
Well, we think that the flows are now starting to look increasingly balanced. So we had incredibly washed out positioning where people got very, very bearish post-Liberation Day. And we think that really contributed to the magnitude of the rally that we've seen. But we do think that flows picture over the coming weeks starts to look more balanced. And we also are in a situation where we think the long gamma position in the market will start to reaccumulate. What that means in practical terms is that can start to become a suppressing force for volatility. So rather than amplifying moves, it can start to suppress those daily equity moves. And we can start to see this more muted reaction to both the data and the policy.
I feel like you're very focused on tariffs. What kind of catalyst do you think this one big beautiful bill can have, which they want done by July 4th?
Yeah, I think it's complicated. From an equity perspective, if we get a bill that's fiscally expansive, then that should be good. And that's how we tend to look at things. But then we have our friends in the bond market who might start to hold us to account a little bit. And we saw a dry run of that recently. So for equities, you are stuck in this kind of range where if something is too good from a kind of expansive fiscal perspective, i.e. it should be good for nominal growth, then you start to run the risk that the bond market gets a little volatile and de-anchored, and that will help cap equities. So we think particularly for things like the small and mid caps, which tend to be very sensitive to growth, very sensitive to rates, we think the upside there is more capped.
Do you think that this bill is a removal of a headwind, or there will be actually a tail risk?
I think it depends what manifests and what comes through it. I think this theme of uncertainty is how we kind of open this discussion. I think there's uncertainty as to what gets passed in that bill. There's uncertainty as to how the bond market reacts to that. And then there's the uncertainty from the tariffs, the growth outlook, and the next earnings season. So for us, that creates this kind of real mix of things as we move through the summer, June, July, August, where there's a ton of uncertainty. And that's where we think owning equity optionality that looks out past that window is for us attractive.
Greg Boutle, thank you so much of BNP Paribas. We appreciate it. Have a wonderful weekend as we parse through, I'm sure, all the headlines that we'll get. Hopefully not over the next couple of hours, but hopefully, and I imagine, over the next few days. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Danny.
Thanks, Lisa. Pfizer announcing that its colorectal cancer drug doubled patient survival time. Adding Pfizer's Bravofti to a cocktail of cancer medicines cut death by 51% during the study and slashed the risk that the cancer would progress by 47%. That met the trial's goals. Dell shares, meanwhile, are rising in the pre-market by just 0.5%. It gave a profit outlook for the year that exceeded estimates. The company says AI server demand is unprecedented. At more than $12 billion, orders last quarter exceeded what it had in shipments for the entirety of last year. Sales of consumer PCs, however, were weaker than expected. And the New York Knicks mounted a comeback from the brink of elimination in front of hometown fans. They beat the Indiana Pacers 111-94 in Game 5 of the Eastern Conference Finals last night. Game 6 will take place Saturday night in Indianapolis, with the Pacers looking to clinch their second ever NBA Finals. The Knicks looking to push for a Game 7 to win their first championship since 1973. And I think we're all thankful for Annmarie sending the good vibes with her mug today. Lisa.
Thank you so much, Danny. She's not just that. She's also scrolling through websites to try to figure out how to get tickets that are lower than $80,000. And potentially, you might be making a trip over to Indiana.
Yeah, the tickets, if I go to Indiana, are much cheaper than if you were to go to Madison Square Garden. Although they do have one very pricey one, courtside. It looks lovely, $82,000. But you could sit up in the bleachers and spend $250.
I'm glad that you're focused this
I thought
morning.
you were going to be happy that I changed mugs.
I am actually very
out
happy.
the Yankee mug for the Knicks mug.
I think that's much safer. One note that I think is interesting, what you can see in the two-year yield, just over the past couple of minutes, you've seen a sharp rally in the two-year, with the two-year yield markedly lower. This is ahead of the data that we're getting in just about 16, 17 minutes time. Question about whether traders are just sussing out maybe some weakness in the inflation data, which would be a good kind of downside surprise. Whether this is just month-end types of dynamics, we will discuss that, of course, as the hour goes on. Up next, the morning calls, plus United Airlines Chief Commercial Officer Andrew Nocella. That's coming up next. This is Bloomberg Surveillance. Welcome back. A little bit of volatility on the heels of this. It wouldn't be a morning without a Truth Social posting from President Trump. The latest coming out, talking about China, saying the bad news is that China, perhaps not surprisingly to some, has totally violated its agreement with us. So much for being Mr. Nice Guy. Hard to know how much of the move in treasuries is attributed to that, but it was in tandem, and you do see the two-year yields coming back a bit after a pretty big rally on the heels of this. Annmarie, do we have a sense of what this post means?
I imagine that has to do with some of the provisions and agreements that were put in place after Geneva. And earlier this morning, speaking to the American press, Ambassador Greer was talking about that the U.S. did exactly what it was supposed to do, but the Chinese are slow rolling their compliance. So I imagine this is something that has irked the president. We heard yesterday from Scott Bessent, the Treasury Secretary, maybe foreshadowing this Truth Social, saying the talks have stalled. It seems like trade negotiations are moving forward with everyone else right now but China.
Which is the reason why we are watching for some sort of phone call getting scheduled between the two leaders. We will keep you posted on that. Right now, though, let's shift our attention to the morning calls. First up, Wells Fargo cutting its price target on Best Buy to $67, citing low room for error, thanks to continued tariff uncertainty. Next up, JPMorgan raising its price target on Ulta to $525, noting better than expected earnings and market share gain. And finally, Truist downgrading Airbnb to sell, saying soft summer leisure trends aren't being fully anticipated by analysts and investors. Sticking with travel, United Airlines and JetBlue yesterday agreed to a partnership that will allow travelers to use loyalty points and book flights across both carriers in the New York City area. I am so pleased to say, joining us now, United Airlines Executive Vice President and Chief Commercial Officer, Andrew Nocella. Andrew, thank you so much for being with us. First, can you just tell us why you thought this was an important deal to do?
Sure, it's great to be here. Good morning. I think United is the largest airline in the world. In fact, I know it. But we also have a few gaps in our network, and we would like to be a better choice for travelers in the New York City area. We're very strong on the Newark side of the river, and we'd like to have a presence on the other side, along with in Boston, that's more significant than we have today. And this partnership with JetBlue is going to get us there.
How much is this tied to some of the issues that Newark has had with air traffic control signals and all of the publicity around that, and diversifying so that there are some options in the New York City region apart from that hub?
Sure, it's a good question. We've had a very long-term goal of being back at JFK Airport. We've been working on this particular partnership for JetBlue for a long time. So what's happened in New York and Newark in particular over the last few weeks is a bit of a speed bump, but the second runway will be operational again in just a few short weeks, and we should be back to normal.
Do you expect other types of agreements like this, Andrew, at a time when we know that airlines have been trying to come up with agreements to flesh out their service area, their options for consumers? Is this kind of the path of travel?
Well, that's a really good question. At United, we've always been focused on the consumer and providing choice, whether it's from basic economy, our most basic offering, to Polaris, if you're trying to go to Singapore and have a lie-flat bed, and now the Polaris Studio, which is our brand new product we announced a few weeks ago. So we're always trying to figure out what the next step is, how to innovate, how to offer more choice to consumers. I think the rest of the industry is just finally caught up with that. I call it the Great Reset. The other airlines are out there doing a big reset, trying to figure out how to gain footing again. Whereas United, we figured that out a long time ago. We figured out the consumer was in charge, and providing optionality was what they wanted. And we're just a step ahead, a generation ahead because of that.
What are you seeing right now that the consumer really wants when it comes to travel?
Well, I think they want choice. And what I'd say is the U.S. consumer has been very resilient. And for example, trips to Japan, I think, are just really in fashion right now. Japan, I would describe as one of our hottest destinations this summer, where everybody's trying to take the family to Japan. I'm not sure we'll have enough seats, to be frank. But the consumer wants choice in a product range. They'd like the optionality of flying basic economy, but they also like, sitting in a premium seat from time to time. And most importantly for United, they like the optionality we provide to go around the world. Whether you're trying to go to Mongolia or Cape Town or anywhere in between, United can get you there.
It's interesting you talk about Japan, because I remember Lisa sent her son to Japan and perfectly nailed it when the yen was really to her favor in terms of doing the currency exchange. Where else are travelers going this summer? Because people have been talking about there's all this concern about whether people are going to spend and travel because of tariffs. But it sounds like for you, it's pretty robust.
Yeah, I think it's going to be a very busy summer, and our airplanes are going to be full. In addition to Japan, I would say that the hot spot, and this is for now the third year in a row, is Southern Europe. We just started flying to Sicily last week, and we fly to Naples, we fly to Rome, Athens, Spain. People in the United States are anxious to get to Southern Europe, and it's just, it's a really great vacation, and I think that is another big hot spot across the globe.
One big question has been not necessarily outbound traffic tourism outside of the U.S., but inbound traffic with people from overseas coming to the U.S. How much have you seen a real drop-off, especially as we have heard a lot of headlines and tensions between the U.S. and other countries?
I think that is a fair point. We have seen a small drop-off. We've talked about it from Canada. There were previous reports that were just completely false. But it is a small drop-off. And other parts of the world, some of it driven by currency. I think Japan is largely driven by currency. But the U.S. consumer has been incredibly resilient. And so from a load factor point of view on our jets, that small drop-off overseas has been more than offset with more U.S. consumers seeking that vacation to Rome or Japan this year.
We're about to get a read on inflation as well as consumer spending and income. And there's been a real question about what's driving disinflation. And it has been airline prices, actually. Airplane tickets have been coming in. And I wonder whether you expect that to continue or whether that was a temporary blip that has changed, especially as people are feeling better.
Well, as you can imagine, airline tickets over the long run are a great bargain if you adjust for inflation, for sure. And we have seen a lot of inflation. I do think, earlier this year, when we did see some consumer weakness, we adjusted our posture in terms of how much we're charging to fly within the United States and around the world. So that did stabilize demand, but yields or ticket prices from our perspective are a little bit lower than we expected this spring and this summer. If you roll back to the very beginning of the year, based on what we see from consumer demand. So we do think there's a lot of bargains out there.
Do you expect that to change later in the year?
That really depends. It's hard to predict the economy, as you know. We spent all day trying to think about that. If the economy gets stronger, then of course we would reset. But once we get out of summer, my guess is these trends will probably continue for a bit. But 2026, I think, is going to set up to be a very great year for United. We have a bunch of new products we're introducing, including Starlink, and new Polaris seats. So we're bullish about the long term at United.
Andrew, it is so great to have you. Before we let you go, I want to ask, just finishing where we started with the idea of JFK versus Newark and the foray into JFK. I'm wondering whether this is the beginning of a broader expansion once again. I know you've had a love-hate relationship with the airport. Is this sort of the first foray into getting a bigger footprint at that hub?
There's no doubt we would like to get a bigger footprint at JFK. We're going to be starting off with a high single-digit number of flights, which is rather small for United. We are the largest airline in the world. So we look forward to looking for more opportunities to expand there. But JFK, not like the other New York City airports, are runway restricted. The runways are very full, as we've talked about often. And so the ability to grow at JFK or any of the three New York City airports is constrained by these runways. So we're sure hoping that there's advanced technology that allows runway expansion to continue. But in the medium term to short term, the runways are full at the New York City airports, and our ability to grow by any airline is quite limited.
We've all experienced that. Andrew Nocella, thank you so much for taking the time. Wonderful to speak with you. United Airlines Chief Commercial Officer there, joining us from Chicago. We are just minutes away from personal income, personal spending, as well as core PCE, but still digesting those headlines just moments ago, Annmarie, from President Trump on Truth Social, talking about no more Mr. Nice Guy.
No more Mr. Nice Guy. What he says is he seems very agitated what's going on with China, saying China, perhaps not surprisingly to some, all caps, has totally violated its agreement with us. Still trying to figure out what the president means when he says agreement to us. Jamieson Greer, the USTR ambassador, was speaking to some reporters earlier, and he talked about how China was the only country to retaliate when it came to these measures, and the president introduced them in early April. And basically, China has put in place countermeasures, including restricting the flow of rare earth magnets, and also saying how in Geneva they agreed to remove the tariffs and countermeasures. But it seems like for the administration, they're just doing it too slowly.
Yeah, well, this might be what Scott Bessent, as you mentioned earlier, and it was an astute point, was talking about when he said it's actually hitting kind of a snag and maybe they ought to get on the phone and work things out. Coming up, we're going to be talking about that, but also another round of economic data, including the Fed's preferred inflation gauge, the core PCE. How much of that reaction, the two-year yield, which is coming back, has to do with tariffs? How much has to do with the potential for disinflation? Lindsey Piegza of Stifel joins us next as we parse through the state of the consumer. "25 seconds to go until we get the key U.S. economic data of the week, core PCE, that key inflation metric that the Fed does look at. We also get a read on personal income and spending, which is important given the state of the consumer and where we are. We are, of course, also watching a rollover in futures, possibly on the heels of the Truth Social posting, ratcheting up pressure on China. Right now, with those numbers of personal income, personal spending, core PCE, let's head to Dallas, where our own Michael McKee, Bloomberg economics and policy correspondent, is getting a tan. Mike.
Getting a tan, I wish. We don't have those numbers yet. They haven't dropped from the Commerce Department, but here they come right now. Personal income up 0.8%. Personal spending 0.2%. Spending went up by 0.7 in the month of March. So a drop off there. We're waiting on the price numbers to come through here, and we have a PCE price index headline of just 0.1%, which pushes the year-over-year number down to 2.1%. We are just 0.1% away from the Fed's target. The core is up 0.1%. On a year-over-year basis, that falls to 2.5% from 2.6%. The other number that we're watching today, the advanced goods trade balance, comes in significantly. We're going to have to get a breakdown on that in a couple of days when we get the full numbers for this. But $87.6 billion, that's down from $162.3 billion in the month of March. And of course, that was when everybody was trying to pull forward all of the imports they could get before we got to the tariffs. So a major change here in the trade situation that should add to growth for the month of April. And PCE comes in as expected, lower than anticipated. Incomes were good. I'll look for the breakdown on that. And personal spending falls off again after people maybe front run the tariffs a little bit.
I'll let you parse through some of the details there. Just to reiterate, as you were talking about, Mike, 0.8% increase in personal income, and you did see a real increase in personal spending of 0.1% versus the expectation of 0%. When you take a look at markets, it is the wrong kind of maybe upside surprise when it comes to consumer resilience, at least for the bond market, where you do see a bit of a retracing of some of the rally yields marginally higher across the curve, as the 2-year is still maintaining some of the declines. A question here about how much we can really lean into these numbers in the currency market. When you bleed it through, we had been seeing dollar strength. Right now, we have seen basically a fading away of that, and now that looks like it's being retraced just a touch. And equity markets are kind of dancing to their own music right now. Hard to say how much this has to do with economic data, how much this has to do with the Truth Social posting, which we'll get into in just a bit, where President Trump ratcheted up the pressure on China. Mike, you've had a couple of minutes to look through, or seconds to look through the details. What are you finding in terms of that personal income pop and what we're seeing about where people are spending?
Well, what we're seeing about where people are spending is an interesting change from last month. Last month, 56% increase in the number of automobiles bought. But in April, housing and utilities were the biggest expenses, up 24.7%. Healthcare follows that, and food services and accommodations. Automobiles, transportation falls to negative 4.5%. So people increased spending by 56% in March, and it dropped off to 4.5% in the month of negative 4.5% in the month of April. The other thing I can tell you that the goods imports fell by 20% basically during the month of April, and that is the biggest drop on record. So what we did see was a lot of front running as people anticipated the tariffs coming. In terms of the personal income, wages and salaries up 0.5%. That's the same as we've seen for the last 3 months. Disposable personal income 0.8% higher, and the savings rate jumps to 4.9%. So it looks like Americans are preparing for a maybe bad period during the economy.
Michael McKee, wonderful as always. Stay close as you get more information, intel from the line items here. Really interesting to see that resilient consumer. We were hearing that from Andrew Nocella of United. We've been hearing that from a whole host of companies where consumers can still spend and they are preparing for what might come next.
Are they preparing for what might come next, or did they front run and buy all the big ticket items? I have family members who went out and did this, and I'm not talking about little items. I'm talking about cars, laptops, computers. They were so worried about prices going up. They did all their early shopping, including Christmas for some people in my family, very early on in the year.
Just some other data points. If you track the Canadian economy, they expanded 2.2% in the first quarter, beating all estimates. It was originally 1.7%. You saw a higher than expected CPI print in Germany this morning. I just wanted to mention that because the global backdrop is less bad than it has been pretty much across the board. And the data that we just got in the United States seemed to really double down on that. Joining us now is Lindsey Piegza of Stifel. Lindsey, what's your take on that resilient consumer and how much their incomes rose as well as their ability to spend on an inflation-adjusted basis?
Well, certainly welcome support from that organic component of income, supplementing consumers' ability to go out into the marketplace and spend, albeit at a reasonably reduced pace. We are seeing some loss of momentum. So the consumer is still resilient, but again, it is at less robust levels than what we've seen over the past couple of years. And this supports exactly what we've seen in the price index, that deceleration in headline costs, reflecting the fact that businesses aren't able to pass on further price increases to the consumer, to the end user, without the risk of losing market share. So while consumers are out spending, they are becoming increasingly cost sensitive. But for the Fed, this is good news. We have a resilient economy, resilient consumer, and inflation that has been decelerating now for the past couple of months.
Is it enough for the Fed to potentially, if inflation's coming down, to think about cuts this year?
Well, I think the Fed is already thinking about rate cuts, but the window of opportunity for action is very limited. Against the backdrop of negative growth in the first quarter, against the backdrop of that deceleration of price pressures, the Fed could act to cut rates minimally, maybe 2 25 basis point cuts mid-year. But as we look out towards the second half, further out towards the fourth quarter, I do expect a more positive impact, a stronger impact from some of these trade policies, from tariffs, to set into price pressures, risking upside momentum in costs and really removing any window of opportunity for rate cuts and potentially shifting the conversation back to rate hikes by the end of the year.
Wow, rate hikes at the end of the year, and that's driven by what exactly? Because the concern of inflation driven by tariff policy?
Well, again, right now, the Fed is walking a very delicate line. There, as we saw in the FOMC meeting minutes, there are downside risks to growth and employment, which we've already seen that storyline playing out, as I said, in the first quarter, and likely to see very minimal momentum in the economy in the second. But by the second half of the year, those upside risks to inflation, I do think, are going to become more prominent. And the Fed has to focus on getting inflation back under control. Now, the numbers this morning in the PCE were favorable. That headline is moving closer to 2%, but the core number still remains stubbornly sticky, up at 2.5%. And again, the risk is to the upside.
Lindsey, Neil Dutta was talking earlier this morning that the housing market is kind of the fly in the ointment for this argument, that you've seen a real fall off in terms of activity, people's ability to buy homes. You've seen even prices come down in certain regions for the first time in years. There's a feeling that that aspect of inflation, which is a massive one, is really going to be more of a drag than some sort of boost, and that financial conditions have actually been incredibly tight in that area. What do you make of that argument?
Well, I think when we look at the inflation numbers, it's going to be very difficult for the Fed to achieve a sustainable 2% level without further reprieve in housing costs. Remember, CPI shelter costs are still up over 4%, so that's double what the Fed's intended target is. And so it's going to be very difficult for the Fed to achieve, again, that broader measure of price stability without further reprieve in the housing market. That being said, we haven't yet seen a sizable amount of relief. Now, price pressures have slowed, but nominally prices are still very elevated as would-be home buyers face near record low affordability rates, so there's still a lock-out effect. And existing homeowners are still facing a lock-in effect, whereby they're largely precluded from offloading their existing property for fear of resetting to significantly higher rates. Remember, even if you're buying a lower cost nominal asset, if you're resetting from sub 3% to up near 7%, well, that's going to result in a sizable increase in your monthly payment, which most Americans simply cannot afford. So that lack of mobility, both into and out of the housing market, I think is going to slow any further progress for the price pressures that we're seeing in the shelter component.
There's a theory out there that the tariffs and trade debates will dampen growth, and that we're seeing that on the margins, whether it's people getting more concerned emotionally and maybe not in their spending habits, as well as companies that aren't hiring as robustly or doing capital investment plans the way that they have been in the past. Why do you think that won't be enough of a dampening effect to counterbalance some of the inflationary pressures and strength, frankly, that we're seeing in the consumer?
Well, I think the biggest impact that we've seen thus far has been on the soft data, on the confidence numbers. Consumer confidence has fallen to a multi-year low as consumers are anticipating these dire conditions coming down the pipeline, driving inflation expectations up to a multi-decade high. But on the business side, we've also seen that. We've seen that impact on confidence come down to a multi-month low, with 90% of businesses saying now is not a good time to hire, now is not a good time to invest. But as we saw this morning, when we look at that hard data, consumers are still spending, businesses are still investing. So it's as if we're vocalizing more concern than we are actually changing behavior. And so again, that's going to perpetuate this resilient notion for the economy, both on the consumer and the corporate side, and help to offset that impact on inflation and still leave us facing significant upside risks in terms of price pressures.
Lindsey Piegza of Stifel, thank you so much for those insights as we parse through stronger than expected income and spending data. Back with us is Mike McKee, Bloomberg economics and policy correspondent. You mentioned this statistic, but I wanted to dive a little bit deeper into it. You noticed that the U.S. April goods imports fell almost 20% month over month, which is the biggest drop on record. Is this essentially the consequence? I think about Gene Soroka of the L.A. ports talking about how much was just delayed in ships that didn't come to the ports. Is this the hard data that supports that?
Basically, it is, Lisa, and you made me laugh because I was thinking the month of April was like, look at this, the biggest drop ever. May could turn out to be a hold my beer moment, given what Gene Soroka's been telling us about no ships coming in at all. During the month, we saw imports of automobiles up by 9%, but exports fell by 21%. I'm sorry, in terms of automobile imports fell by 19%. Exports fell by 21%, so the auto industry just completely stalled out. Foods down 4.4% in terms of imports, capital goods down 3.1%, and industrial supplies down 31.1%. So it looks like companies just went out and bought whatever they could in December, January, and February. We got to March, it started to fall off, and in April, imports just stopped. And now we have to see what happens in May because according to Gene Soroka from the Port of Los Angeles, we are not seeing anybody bringing anything into the country at the moment.
And potentially those tensions are going to ratchet up, what the president saying today. China's not abiding by them. Mike, I'd also love to get your take on just what we heard from Lindsey. She's saying that all the trade and tariff noise can potentially mean the Fed talking about a hike if this leads to inflation at the end of the year. Do you hear anyone at the Fed talking about potentially putting a hike on the table?
No, and they get asked about it all the time. They say they don't think there's any reason for that at the moment. One reason is because the inflation rate has been coming down, and they still think that they have a tight policy. But the other is that if this is tariff-driven, there isn't much the Fed can do about that. Raising the interest rate isn't going to change the tariff situation and any kind of price increases brought about by those. So the Fed's a little bit handicapped. It would only be second-round effects if people start going to their bosses and asking for additional money because they have to pay more for goods that are tariffed. So at this point, I don't think we're really talking about increases. And we're not even talking about cuts at the moment. What we're talking about is how long are we going to have to wait until the Fed has any idea of what's going to happen.
Mike, thanks so much. Enjoy Dallas. Michael McKee there of Bloomberg. I just want to bring this to you. Just crossing the Bloomberg terminal, that OPEC Plus is said to consider an increase of more than 411,000 barrels per day for July at a time when we're talking about possible disinflationary forces. You take a look at oil prices, they're lower by an additional 1.2% to $60.22. And it just highlights the push-pull on so many different levers about the supply-demand dynamics in oil and what the ramifications could be for inflation.
Well, I would say that redhead is certainly music to the ears of this White House. And Bloomberg actually scooped that OPEC Plus was thinking about doing this, a.k.a. Saudi Arabia. Two reasons why I think we need to think about this. One, they are trying to make it very clear to the cheaters that are non-compliant, like Kazakhstan, in the group, that actually you need to comply. And if not, we are going to make this challenging for you. And second, what a better time than to do it now than to get the foreign policy boost that you're going to get. The President of the United States came to Riyadh, gave his transformational speech in front of Mohammed bin Salman, basically charting a new course in foreign policy. I imagine oil was discussed.
Looking at average national gas prices in the U.S. right now, $3.16 versus a high on April of 3.3%. It's been actually really somnolent. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Danny.
Hi, Lisa. Tensions rising between the U.S. and China. President Trump accusing China of violating its preliminary U.S. trade agreement. That occurring after Treasury Secretary Scott Bessent said trade talks with China have stalled. The president also met with Fed Chair Jay Powell at the White House for their first in-person meeting since the inauguration. The Fed says that the president invited Powell to discuss economic developments, growth, employment, and inflation. White House Press Secretary Caroline Leavitt says that Trump pushed Powell to lower interest rates, but did not discuss whether Trump would seek to remove Powell from his role. And the Edmonton Oilers punched their ticket to the Stanley Cup final last night with a 6-3 win over the Dallas Stars. The Oilers were led by center Connor McDavid, whose breakaway goal swung the momentum in Edmonton's favor. The Oilers will face the reigning champs, Florida Panthers, in a rematch of last year's final. The best-of-7 series starts Wednesday in Edmonton. And that's your brief. Lisa.
Thank you so much, Danny. Up next, setting you up for the week ahead, plus Sonal Desai of Franklin Templeton. Let's get her take on what she thinks about a Fed rate hike later this year. This is Bloomberg. Well, we got that key economic data, and for the most part, markets have retraced most of any moves that you can see. Two-year yields still marginally lower, 10-year and 30-year yields marginally higher. Didn't really move the needle. What is moving the needle maybe is what you can see in the stock market. You do see flat market turn more negative, although that's also retraced. It seems like everyone's trying to figure out how to understand this, which is the trade headlines that we are getting, and the latest being President Trump, and the latest out on Truth Social, having to do with China and no more Mr. Nice Guy. We'll get to that in a second. Coming up over the following week, we do get ISM manufacturing. Watch this space, given the fact that we just got the decrease in imports to the U.S., jolts and durable goods on Tuesday, Thursday. Jobless claims will be interesting, ongoing claims, and Friday, of course, is the big event, May payrolls. A busy day in Washington ahead as President Trump turns up the heat in China. Bloomberg's Mike Shepard joining us now to decipher what this Truth Social post actually meant. Mike.
Well, from reading the Truth Social post, it's clear that the president is displeased with the progress in discussions with Beijing on getting to the next level of an agreement with China that would settle some of their differences on trade. But he did not elaborate on what had set him off. We did, however, get a clue from his top trade negotiator, Jamieson Greer, who was interviewed on another network, CNBC, and told the audience there that, look, this is much more about the non-tariff barriers that China has put up and that they are slow walking in lowering. And he was referring specifically to curbs on exports to the U.S. of rare earths and critical minerals and magnets used in high-tech products here in the U.S. And this was a key win for the U.S. in coming out of this discussion with China just a few weeks ago in Geneva. Remember, Beijing had imposed those curbs in retaliation for U.S. export curbs on semiconductors and on semiconductor manufacturing equipment as a way of retaliating against that. The Trump administration wants to see more progress more quickly on that front. And apparently they're not getting it. We have not heard yet back from the Chinese government. A call has gone to them after hours seeking their comment. So far, we have not heard back yet, Lisa.
Shep, thank you so much. That's Bloomberg's Mike Shepard from Washington, D.C. Joining us now is Chanel Desai of Franklin Templeton. In this whack-a-mole world that we're in, we go from what's going on in Washington to what we're hearing on the front of economic data. Chanel, what do you make of what we just saw coming out of the Bureau of Labor Statistics?
So if I look at that whole slew of data, ultimately, Lisa, it is quite messy. It's going to be messy for a little while. I don't think it moved the needle very much, really. It's very difficult to interpret, clearly. And then when you look at what's going on with imports, it's impacted by so many different things. On the one hand, you've got the port issue that you were referring to. On the other hand, you had so many importers who imported early to try and front-run the tariffs. So you don't know whether it's payback for that we're seeing. Are we just seeing a reduction due to ships not being able to dock? Just really hard to read the data right now. I think that's where I'd come. I haven't changed my views on the back of the higher frequency data that we're seeing right now.
When you say messy data, do you mean just basically paralysis, lack of clarity in Washington?
No, actually, though there is, I mean, that's happening. But what I would say is I'm really referring to the fact that the actual data moves are distorted by people's behavior, companies' behavior, which is in response to prospective changes. So, for example, we didn't really have GDP contracting by that amount during Q1. We had a massive expansion in the trade deficit on the back of front-running of imports. For example, you just don't know how much of that is bleeding over into the next month's data and will continue to do so. So, for example, if we see a massive contraction in imports in the second quarter, you're going to get an artificial bulking up of GDP. So I think right now, a lot of the data is being impacted by these moves, which don't really talk to the underlying strength of the economy. In particular, a lot of people have been talking to the confidence indicators. I really think that this is one time when confidence indicators may follow hard data rather than hard data following confidence indicators, because those confidence indicators are so impacted by rhetoric and overnight tweets for example. And the hard data is how people are actually responding.
So now, if that's the case, and I'd just love your take on this, Lindsey Piegza was talking about how the Fed might even have to put a rate hike back on the table later this year because of the strength that we're seeing in the consumer, but also potential inflationary pressure from tariffs and just that ongoing strength. Do you agree with that?
You know, I think the bar for raising rates is very high, but I would like to address specifically the issue of tariffs leading to inflation. We have a roughly $30 trillion economy. 70% of it is consumption, 70% of consumption is services. So when you come and you narrow that funnel down as to where the price increases will actually happen, it's rather small. So when we calculate it, even we see a 0.5 to 0.9 percentage point increase based off tariffs. And I think that's probably too much. I mean, even that is probably a high point in terms of what would happen. So I don't see the Fed responding to a 0.5. I mean, it wouldn't be great, but we're not going back to those 9% levels.
Sanal Zasai, Franklin Templeton, thank you so much for being with us on this Friday after a long month, a long week. And it comes with gains, Annmarie, the idea that all the trade turmoil actually ended with the biggest monthly gain going back to January.
Right, but we're going into the weekend once again with uncertainty. Sunday evening is going to be also challenging, depending on maybe how China responds to this. The President of the United States says they've totally violated their agreement with us.
We will parse through it all coming up on Monday. Russ Kostrick of BlackRock, Matt Hornbach of Morgan Stanley, Sarah Hunt of Alpine Saxon Woods, and Victoria Fernandez of Crossmark. We'll be parsing through all those headlines. Maybe there won't be any, but I can't really guarantee that. Go Knicks. I see you, Annmarie. You're very excited. This was Bloomberg Surveillance. You're like,
it's a big game on Saturday.
I know it is. You're trying to get